Good morning, and thank you for joining us for the December 1st Chicago Teachers Pension Fund Investment Committee First Friday meeting. For the record, I am Jacquelyn Price Ward, Vice President of the CTPF Board of Trustees and Investment Committee Chair. This meeting is being held in person at our office at 425 South Financial Place. The Investment Committee is a committee of the whole and includes all CTPF trustees. A quorum for this committee is 7 trustees. The committee is meeting today for our first Friday educational presentations. Please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussion from each trustee to 3 minutes. Please note that our staff and trustees to focus on the business of the meeting. We will not be responding to messages from participants using the Zoom chat feature. Please forward questions to memberservices@ctpf.org. That email address, memberservices@ctpf.org. At this time, I'm going to call for public participation. Do we have any members of the public who wish to be heard? If so, please raise your hand or send a note in the chat. Please limit your statement to 3 minutes each.
We have Ms. Tina Padilla.
Okay. Trustee Padilla, hello, how are you today?
Very well, thank you.
Former trustee Padilla, sorry, I'm so
Yeah,
used to
you
saying
know
that.
what? I go by everything. My name is Ernestina Maria Padilla, and it goes on and on and on, but everybody knows me as Tina. You could call me anything you want, just don't call me late for lunch, because that's when I'm usually really hungry. But that's my joke for the day. Okay, the reason I'm here is
Go ahead.
hey, thank you for being the chair of this important committee. Part of our stability depends on the wealth and the growth and how well we manage our managers who are managing our funds, our hard-earned money. And I am going to, I just wanted it to be in the public record. I am part of the Pension Advocacy Group's mission is to fill that gap. PAG, Pension Advocacy Group, backwards is GAP or GAP, the gap that is needed to be eliminated, meaning the beneficiaries and the people who are counting on this money to be there need to be educated more and need to know what's going on. So to support our elected officials who are sitting at the table for us, we want to help you do what you do on the board. And one of the things is the communication piece. And Jackie, I know you were the chair of the communication, and you were very passionate about being the chair of the communications. For example, one of the things, and I know it's in the director's report, but some of the things on the director's report, the summary of the contributions specifically, there's things like normal costs. I personally know what that represents, but members who are not, didn't spend 12 years as a trustee will not know this. And on the report, there's also HI. We don't know what that is. If the communications could break that down and line by line, which has started to happen now, but members' contributions, the money from the state, AKA for our services that's coming from this, it has to be a little bit more specific because we don't do the work that you all do. We're just teachers working really, really hard on our jobs, and we need this little bit of help. So that's it for now. Thank you for your service. And the communication piece about the summary, like the fiscal year 2023 contribution summaries, that needs to be a little bit more detailed. Thank you very
Okay,
much.
thank you.
Have a
Thank
beautiful
you
meeting.
for participating.
Keep on keeping on, guys.
All right. Is there anyone else for public participation? Okay, seeing no one else for public participation, I will now call for the roll call.
Trustee Barajas,
Present.
trustee Blackwell,
Present.
trustee Nelson,
Present.
trustee Ochoa,
Present.
trustee Price Ward,
Present.
trustee Travlos, trustee Vincent,
Present.
trustee Washington.
Present.
That concludes roll call.
Thank
Trustee
you.
Woods is here telephonically.
Okay,
Trustee, what I was going to have them do is the quorum established in person. What we're going to do next is do the allow of the remote attendees and full participation, and then you three will be added to the roll.
thank you for the roll call vote. And we do have a quorum. We have 7 trustees on site, and I believe 3 trustees remote.
Correct. You have trustees Riley, Rodriguez, and Woods remotely. I am assuming that they're going to be requesting to have full participation, so that would require that next vote.
Okay, so in order to conduct this meeting, we did need a quorum. And I want to repeat, there are 7 trustees members on site. So therefore, we will move to item number 3, a vote to approve remote trustee attendance and full participation. Can I get a motion and a second?
So moved. Second.
I never get to make motions. Let me make a motion.
Yeah, you made a motion. Okay. Now we're gonna move to the approval of these trustees.
Yeah.
So, okay. So we did the roll call. So do we need to include them?
You need to do a roll call vote on that motion that was just
Okay.
made by
right.
trustee Washington and
Okay,
seconded by trustee
nobody-
Blackwell.
Okay, because I saw that. Oh, yeah.
Can I add, they also have to indicate why they
Yes.
are removed? Okay.
Yeah.
That is correct.
That is absolutely right. So we will have a roll call on the motion to approve remote trustee attendance and full participation.
Well, let me ask the question before to trustee Nelson's point, she's correct.
Yes.
Let me ask the 3 trustees, are you attending remotely for one of the allowable reasons under the Illinois Open Meetings Act? Illness, work, daycare, other health emergency?
Yes.
Yes.
Oh.
State your name when you answer, please. Say yes, you're Mary Sharon Riley, because we have 3 people online.
Yes.
And you put yes in the chat.
And trustee Woods put in the chat, yes, as
Okay.
well. Thank you very much, trustees.
Trustee Padilla, I mean, not Padilla, Rodriguez.
Yes.
Okay, okay, thank you.
Now we need to vote.
Yes,
Okay.
okay.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes,
trustee Vincent,
Yes.
trustee Washington.
Yes.
That's 7 ayes.
No, thank you.
okay, now we will move to item 4, approval of the minutes. Approve the October 6th, 2013 Investment Committee, first Friday minutes.
So moved. Second.
It has been moved in second. Can we get a roll call vote?
Trustee Barajas,
Yes.
Trustee Blackwell,
Yes.
trustee Nelson,
I was not in attendance, so abstain.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No, at this time.
trustee Benson,
Yes.
trustee Washington,
Yes.
trustee Woods.
Yes.
Thank you. Now we will move to engagement update. Our CIO, Fernando Vincent, is coming to the podium.
Good morning, everyone. Happy rainy first Friday. So just to preface this whole meeting, the purpose of First Fridays usually is to allow MWBE firms and emerging managers to get a direct audience with the board. Usually, the goal is not to award direct mandates necessarily, but to start to get them in front of you, and you start to get acclimated to a lot of the MWBE managers. More recently, we've been more thematic about these things. Also, we've wrapped a lot of the meetings, First Friday meetings, around the theme and brought in managers who either address those themes or have funds that traffic in that kind of theme. For this First Friday, the theme is climate aware investing, and so along that vein, I thought I'd give you an overview of how much we own to date. Usually we've been doing this at least twice or two to three times a year. But turning to page 1 of the presentation, we currently have 367.8 million in coal, oil, and gas exposure. That's down from 380 million back in April of earlier this year, mostly due to actions of the market. Oil has pulled back in. It's at about $75 per barrel right now. When I think the war started in Ukraine, that price spiked up, and as a matter of course, a lot of the stocks that benefited directly from that price also went up in market value. So we saw an increase in our own market values as well. That has pulled back in from $100 or over $100 to again $75 because of weakness in several large markets, and so that's why you're seeing a pullback in our total dollar exposure. But the composition of holdings hasn't changed significantly. But turning to page 2, we're starting to kind of dissect a little bit more about what we own. Of that 367 or almost 370 million, almost half and half is active versus passive. As well, from an asset class standpoint, 42% is in domestic equity, 39% is international equity, and the remainder is mostly bonds and some other exposures. And in terms of country, where are these coal and oil and gas companies domiciled? 60% is in the United States. And not surprising that the second biggest one, Australia, which still trails by quite a wide margin to the United States, most probably is because of the coal exposure, coal companies. So we thought we would provide a little bit more. We're starting to dissect what we own, and one of the firms also that we've invited to present today, they've had a chance to take a look at our exposure, and they'll have a little bit more revealing insights on who the biggest culprits are in terms of what we own and how they're not contributing to cleaning up the environment. In terms of stewardship options, again, if you recall, selected Glass Lewis as our proxy service provider. We recently added some items onto our proxy voting policy, and we'll be wrapping that up by first quarter so that we can be voting our positions in time for proxy voting season. And then other next steps, we had said that the international equity RFP, which we may bring in managers who do have climate aware or ESG overlays. We're pushing that to the January meeting because of some constraints in getting prepared for by December. But at the same time, also you've got a much more curtailed meeting in December. So we thought it'd be best to push it back to January. And then our next fossil fuel engagement update, we're shooting for May. And then again, the goal of once we get through the major searches we have, which is international equity, private credit, and then eventually fixed income, then we will focus on divestment and offset strategies as we work with Callan. So again, the four that we brought in run the gamut from the first one would be kind of almost have a consultative approach to their business. They have had a chance to review our ownership and what we own and exposures. The second one has more of a flavor for how you offset what you own versus what you could put it into for a full offset strategy. The third one is more traditional climate aware investing fund. And the fourth one is more private equity on the farther end, which is, these are funds that are looking at new firms that are really looking to provide solutions on the clean energy end. A lot of the new approaches for clean energy aren't yet public because they're new technology, so we wouldn't have a chance to invest with them on the public side. So we thought this was a good range of managers to bring in and give you exposure to what's out there. I think Callan will attest to a lot of this is all very new, so they don't all have yet a lot of assets yet. So, but at least you'll start to hear the different approaches and what we could look forward to. And it's also rather timely that the COP is happening. It started yesterday. It's ironic that there's a lot of funds have been making moves, not unlike what we're trying to do, but somehow yet emissions still keep going up. So somehow both industry and government have to both collectively work together to make an impact. But I digress. I will turn it over to James to get the presentation started.
Good morning, Shauna. Good morning.
Okay. Good morning, legal and general, and welcome to Chicago Teachers First Friday. With us today, from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, and joining remotely, Trustee Rodriguez, Trustee Riley, and Trustee Woods. Our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Brianne Weymouth, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Great, thank you. Can everyone hear me okay?
Yeah. Pull it up a little closer.
All right. I don't want to get too loud, but I want to make sure you hear me. I think what we're going to do today is limit our presentation maybe to 15 or 20 minutes just to give more question and answer time if that works for you. For those of you I have not met, I'm Shauna Hewitt. I am a senior investment director. I focus on our Midwest plans and consultants. I had the fortune and the privilege of working with Chicago Teachers back in the day, a few years ago, and I'm just so excited to be back here today and really thank you for your time and attention. We have a long name, so I'll just get that out of the way. It's Legal and General Investment Management America. You're not going to hear us say that very often. You'll hear LGMA or LGIM America, but just making sure you're aware it's all one thing to us. I have been at the firm for about 6 years now, and I brought a senior team with me today that I'd like to introduce you all to. Directly to my left is Neil Olympio. He co-heads our solutions strategy team. He joined us about 7 years ago, and he brings his consulting background to developing customized solutions for our clients. And we're going to talk about customization again and again and again today, but we'll get into that in a minute. Next to Neil is Dave Barron. Dave Barron is head of our U.S. Equity Solutions. He's been with us close to 10 years. He recently moved back to Chicago from the UK, where he developed solutions specifically for our European-based clients on ESG equity solutions as well. And then finally, down at the left is John Hepner. John is head of our U.S. Stewardship and Sustainable Investments. John's been with us almost 6 years as well. And he focuses on direct engagement and with companies and building, clients helping develop their investment policies around ESG. I hope everybody has the book in front of them or on the call. Okay,
Yes.
there it is,
and-
right there.
Yeah,
Okay,
it could
good.
be on the screen.
Okay, good. Well, please ignore the picture there. That's not a good one. But I'll quickly summarize the first few pages all together. Legal & General has been around since the 1800s. We have 1.4 trillion in assets. We're actually the 8th largest global investment manager as well. About 16 years ago, we opened our US headquarters here in Chicago. We now are proud to manage about 200 billion in assets. We have 260 employees, mostly here in Chicago. We have to acknowledge COVID changed a few of those numbers, but mainly based here in Chicago. And we also work with 501 clients today. We really initially focused on corporate DB plans. And over time, we started going into more of the public space and union plans. Now we have 75 public and union clients, and that represents about 15.5 billion in assets as well. Finally, we manage 38.4 billion in ESG or sustainable assets. And, I think ESG or sustainable assets, climate, there's a lot of different words for basically what we're trying to do is better our planet and better our future people here. It's gained a lot of attention in the institutional investing business. However, I would argue that public funds have paid the most attention to it. And that's exciting for us. And I think when you look at Chicago teachers, you've already been an ESG investor. You've implemented the diversity factor into your business. And I don't need to tell you, you're a very early adopter there. So we would like to stress this does get complicated. It might feel a little overwhelming how you introduce some of these climate factors into investing, but I just want to assure you, this is what we do. We'll talk about our firm a little bit, and I know you're not that familiar with us, but again, we build customized solutions for our clients. We are very heavily regarded for our work in engagement, sustainability, and ESG investing. So I think right with that, I would like to make sure that everyone is fully aware. Please ask questions. We want to make this as interactive as possible. And that's really what this is all about. So I'm going to kick it off to Neil from here.
Thank you. Thank you very much. You can all hear me well. Morning, everybody.
Good morning.
So in the interest of time, we'll get straight to it. The journey for us starts on slide 8, which is the commitment that was made public back in 2022 in relation to divesting.
Mm-hmm.
As a solutions business, we know there's no one-size-fits-all solution to this, right? There's no silver bullet, or if you will, there's no single fund that's going to solve it all for you. We have to reflect the specificity, the constraints that you have, right, as an organization, and no two plans are the same. So our approach always starts with an understanding of, what you're looking to do, and first of all, what you own. Getting an understanding of what you own is critical in order to be able to provide the best approach for you. And that's how we work as a business. First, solutions first. No one size fits all. The key thing I just want to mention is it could feel overwhelming, daunting, sometimes even lonely to be on this climate journey, especially in an environment that's politicized. Now, we understand that very well, not only because we have worked with many clients on these topics, but maybe more importantly, because we've done it for ourselves as a firm. We have climate commitments that we abide by. And that has led to us building tools, processes, systems to make sure we can actually fulfill the commitments that we have agreed to do. In doing so, we started with a list of a potential divestment list that you have of broadly coal companies to get a full understanding of what you own and also what you might be looking to divest from. And we'll have some conclusions on that we'll be able to share today with Dave and John. Now, if you take a step back about the approach that you have, what we'll suggest today is a couple of things. One is there's the divestment approach, and there's another one which is more of the active engagement approach, which we'll be touching on here, because we believe this could be of benefit to you as a plan. If we think about the divestment approach, our objective here is to divest as effectively as possible. And the reason for this is that there is a trade-off between the financial risk and the climate benefit you're looking to achieve. So if we don't take that into account early on, we run the risk of having unintended consequences on the financial side of things. Think about portfolio risk and return, within an index context in particular. So that's the first thing, is that trade-off is extremely important. And that's why it's important to divest as effectively as you can. And with that come a couple of things. One, the understanding that any static list that you have from a divestment perspective will expose you to a risk of missing out on some companies that might today be labeled as coal company, for example, but they might have already announced their intentions to exit that business. Mm-hmm. And there is such a company called Tech, for example, in your portfolio that we identified that is today labeled as coal, but they've actually made their intention clear that this is over for them, right? It's being transitioned out effectively. So this is why it's important to have more of a dynamic list and the ability to look through it over time. So it's one thing to generate the list, it's another thing to maintain it, to make sure it remains relevant. And that's the type of things that we have been working on with our clients. Within divestment, one thing is that the list, as we said, that should be a bit more dynamic. But the other thing is there are loads of questions that one might need to answer. Should you divest of all companies at once, for example? If you do, what's the impact on the portfolio? Mm-hmm. Is there a hierarchy among those companies in terms of who you should divest from first, potentially, right? And if you think about it, is there a difference between a company that's labeled as coal company if they are using coal for energy purposes as opposed to steel, for example? So all of different questions that one needs to take into account as you come up with that list and as it evolves through time. So the generation of the list is, yeah.
Okay. They'll stop for questions, correct? Okay. Well, mine is a quick one. It's in terms of this coal tax. If they're leaving coal, going to something else, what do they have in mind? Mm-hmm.
And that's one that we'll actually are planning to cover.
Oh, then I'll wait. Okay.
Yes. Yeah. We have that scheduled for you because we thought it was a good example to walk through. Absolutely. So we'll cover that in a second. Mm-hmm. And so divestments, let's try and do it as effectively as possible. The other side of the coin is what we call active engagement here. Mm-hmm. And so you think about companies, what do we mean by this? Think about companies that might appear to be late to what I call the climate transition party, if you will. But they have a high potential of catching up quickly. Should we divest from those? Right? That's part of the question that one needs to ask, because you might be selling them today to buy them back a year from now, potentially. Additional transaction costs, right? Mm-hmm. Whereas our ability to engage with them actually speed up that transition, and you might not need to sell them today, right? So that's the concept around active engagement, and we've done this with hundreds of companies that John will be able to talk through. So before I hand it over to them, the last thing I was going to say is, what are you looking at divestment? And as we said, effective divestment, as we said, this is something we've done across multiple clients and across the globe. I think this is probably around 120 billion of assets that we've advised on when it comes to divestment. If you're looking at more of the active engagement approach, this is also something we've got a lot of experience with and that John will be covering. But what we found for our clients more recently is they have been very curious about blending the two. Is there a way where we can actually marry the two? And the good news is it's not only possible, but it can be very effective approach to do. And so with that, I will transition to John to cover that part.
Great. Good morning. So let's flip to slide 9. And I briefly want to introduce the concept of climate-aware investing, or ESG investing, and the confusion that is all of us have when discussing this topic, because it means a lot of different things to different investors. And it's actually been quite political, as you're, I'm sure, aware. So we like to define it in 3 different ways, because it helps you see what was the purpose of that big statement you made 2 years ago. So the top idea is around stewardship. And the concept is your money has purpose, has value. And it actually has a lot of influence in the market. And so so your money has influence, but our money bundled up as a $1 trillion asset manager has tremendous influence in the market. Less to do with how we buy and sell, but actually the influence we use, that's called stewardship. Solutions is when you build a divestment solution right into your investment purpose. I want to exclude coal and gas, whereas integration is looking at, I'm willing to invest in oil and gas companies at a certain value, but I want to really understand the trade-offs very carefully. So I just wanted to frame that right up front to dive into really briefly our stewardship credentials, because that is what is going to set us apart from, I think, many other managers you may learn from. So next, let's flip to slide 11. So across our $1.5 trillion of assets, which we are part of our organization, we use all of the various tools of stewardship. As Neil mentioned, there's an interesting trade-off. Do you divest out of companies that you perceive as laggards, coal companies, gas companies which aren't transitioning, or do you engage with them? And the more assets you have, the easier it is to engage with them, because when you send them a letter or give them a call, you say, we actually own $300 million in your company, and we want to see better transparency. And we have a really long track record of being leaders in this space with a lot of interesting, distinctive pieces. For all 11,000 public securities in our portfolios of all of our clients, we put our views in the public domain to drive change, both across their diversity, their management quality, their climate portfolio, their climate strategy, as well as their governance that's in the public domain. And there's even a specific score related to their climate transition ability. How likely is it that they are going to hit net zero and various climate commitments? It's done by sector, and that way we can engage with everyone at scale instantly. So right now we could go on a website and see every company, all those coal companies that are in your divestment list. We can see how poor are they both on their emissions profile, but their whole governance strategy. We also do collaborative engagement. So we group up with other like-minded investors on climate issues, for example, Climate Action 100, where we're a lead investor on a few different global companies, a few different oil and gas companies in particular, where we even file shareholder resolutions. So that's being particularly active in taking a stance. I would also mention that on a more local basis, so that's a global initiative, on a more local basis, we're very active in MIDI, which is the Midwestern Investors Diversity Initiative, chaired by the Illinois chair, the Illinois State Treasurer. We're putting pressure on companies that have lack of diversity locally. So these issues are beyond just climate, but it's actually showing kind of, we really kind of walk the talk. And lastly, from an external perspective, we've received many accolades that all the pressure we're putting out there is actually, it matches our rhetoric. So many different managers will say, we have a climate policy, this is pretty important. But when you actually look at how they vote, you might see a huge disconnect. So roughly 2/3 of all shareholder resolutions on climate issues or social issues, we say, that's a great idea, we vote against management. The actual results in the market are less than 20% of those proposals are supported. So there's a huge disconnect between what most managers say, yeah, that's important, and when it goes time to vote, what they actually do. Now, you may bring your vote in-house, which is a great idea because everyone should be voting in-house, but what manager you work with sends the signal, because when you're engaging, they know, oh, that manager is likely to vote this way or another. So it really does matter how you vote and how it all fits together. I'll pause there and pass it over for Dave to walk through solutions.
Hopefully everyone can hear me all right. Slide 14, we can just kind of jump to and definitely want to save time for any Q&A on how we approach this. Hopefully the biggest thing you can take away is from the presentation today is we have a lot of tools in our toolkit to help clients understand the risks and opportunities really in implementing these types of decisions into their broad portfolios. It's really important to be precise, and the tech resources example is a great one. If you just model, you look at sectors, you look at what's labeled as coal, the definition of how a company gets labeled coal is critical, both for upfront today point in time categorization and then future where are they going, what's the trajectory. Tech is a good example, mostly involved in mining. It does precious metals and coal. It is selling its coal business to Glencore, huge metals mining global corporation, and basically through investor pressure, one of the things that they cited is getting out of that business. So if you were divesting from tech because they're on your coal list, they're flagged as currently coal, they're not going to be coal in a few years' time. And so is that a company you'd actually want to hold and harness now, because you're going to get the benefit of what happens to tech after they get out of coal? And that's how we really approach this. We use a lot of tools, a lot of detail, a lot of investment power, a lot of stewardship and engagement to try and build tools to help investors understand which one of these potential bad actors is going to be a bad actor tomorrow and in 10 years' time versus which ones aren't. And the benefit of using kind of almost a more active approach to sculpting an exclusion list is that we can minimize the impact on your risk and return and hopefully improve that. And that's where we spend a lot of our time, is just analyzing a little bit. Because we're a big asset manager, we hold a lot of companies, 20,000 plus securities that we can analyze. We have a lot of detail that we can pour into and over solutions. 14, there's a lot of words on the slide. One of the ways we help investors, we know a lot of investors have equity market beta, so passive assets, broad exposure to a lot of securities. Implementing an exclusion list there can be tricky because it can create a lot of noise. The way we work with clients in this space is we kind of help you own that exclusion list. We spend a lot of time really analyzing, are these important companies to exclude and why? And can we use advanced metrics to help minimize the impact on that part of the portfolio? That's very different than just send me your list, whatever you've decided, and we'll do our job. We take our fiduciary duty very seriously and really attempt to deliver your investment outcomes, and we'll design solutions around that. We really want to make it easy as well and cost effective. Because we do this on such scale, and we've got some clever tools at our disposal. We try and minimize all those hurdles of moving into a solution that may increase risk or increase costs. We kind of drop those barriers down and make those 2027 commitments, at least on that passive part of your portfolio, very achievable. Wanted to jump to slide 15 briefly, and then 16, just to kind of show you the power of what we can look at. As was mentioned, I believe we did get a peek at some of those securities deemed oil and gas and coal. One of the, and I'll try and just give you the 30-second view of this. One of the tools that we have is estimating forward-looking amounts of carbon emissions a company is going to emit. So if you're a bad company today, are you going to be a bad company tomorrow? And can we assess what kind of trajectory you're on? For that very reason of, if you're on a good trajectory, maybe I hold you. If you're on a bad trajectory, maybe I sell you. Slide 16, lots of fancy bubbles. This is some of your portfolios. The size of the bubble is the amount of exposure that you have. But what we do, what we've seen a lot of clients do, and we've done this with clients both in the US and globally. This is the list that we get sent, 50 some odd companies that are in that kind of nefarious bucket of coal and gas. And we run it through some analytics, and we say, actually, right now, today, all those orange companies there, Tech Resources is hidden, the blue company on the top left there, they're actually probably okay. They're not in this zone of maybe can't be helped. And so we've taken 50 companies and we said, out of all those 50s that most clients would exclude, it's actually really only 15 that you got to worry about today. And through our stewardship prowess, what we do is we try and pick those companies and tell them, watch out, you've got trouble in the future if you don't start changing your behavior, changing your businesses, divesting from some of these assets that are going to be a drag on your potential portfolio performance. So that is what we can do, and we can help you do, is really minimize the impact of kind of a broad strokes implementation of exclusion lists, and do that in a very risk, return, and cost conscious manner. Really quickly, because we've got kind of a barbell approach, just wanted to put what we call our climate action strategy in front of you, and probably the best slide is maybe 19, or let's see, 19 quickly. We've seen a lot of different products out there. We've built a lot of products. A lot of climate products end up being a large technology bias because technology companies don't have a lot of carbon emissions. They're obviously not involved in the oil and gas. So you end up excluding a lot of those big oil and gas companies and reinvesting in technology. And that's great. A lot of good products out there that do that. This is a little bit of a different approach that again harnesses all of the things that we think we're good at Legal in General, where we try and find unloved companies that are on the fringe of that. Maybe they're about to move into that not so good bucket of if there's a big energy transition, they're not going to make it kind of analysis. And we engage with them in detail. We invest in them and engage with them and help their boards understand what they can do to get out of that potential danger zone. And it's a big part of what we do. This is a strategy that we've launched for a large public fund, and it's much more of a narrow portfolio of 50 securities, again, more of a value tilt, find the unloved, find the potential leaders of tomorrow, and try and transition their businesses through the stewardship voice that we have. I'll conclude there because we threw a lot at you. We're a big firm. We've been doing this a while. I would just say it was fantastic being in London, seeing how clients over there were attacking this, and having come back here, having that knowledge, and working with folks like yourselves and other public institutions to kind of just enlighten and showcase different ways to attack these problems is what we're all about.
Thank you so much. Very interesting. And right, what we were kind of looking to see how you would do this. So do I have any questions? Okay, I have Paula, then Lois, then Victor.
Hi, my name is Paula Barajas. I actually have heard of your company. You were in the Majority Action Report. Kudos to you. So how much do you invest in any private equity?
Right. Yeah. Most of the assets that we run are in the public equity space. We do have some real assets exposure. We have an exciting real estate equity proposition, but the vast majority of what we do is in public equities.
Do you have a percentage you could give me?
99.5. Yeah, it's going to be a large. Yeah, the 1.6 trillion is predominantly public equities and fixed income.
And then when you indicate, am I supposed to just ask one question, Jackie? I better make sure.
You can ask two questions.
And when you indicate, I have 4 here, so I'm trying to pick which question is the next one. Are you using the ILGA scorecard or the majority action key indicators?
So I'm not as familiar with the ILGA, but I am very familiar with majority action indicators. And just for everyone's benefit, majority action is a third party, a nonprofit that evaluates asset managers on various climate commitments and diversity commitments. And they try to make it as comparable as possible. So they'll pick a few marquee companies or marquee proxy votes and see how consistent were you? And so we're aware of them. We don't use them, like we make our own decisions, but we tend to rate well with them because our actions are fairly aligned with our public statements.
So I would probably suggest that you think about the ILGA.org and their diversity and governance.
Okay.
I will say for my other trustee members in the Majority Action Report, you guys did a phenomenal job voting against boards, which is not easy. And so thank you for doing that. I think like 4 out of 44, which is not easy for a company to do. I mean, there's repercussions for that, right? Sometimes. So thank you.
Thank you.
Building on what Paula just mentioned, I was on that page, 16, where we have natural fuel gas company. And now they're talking about taking gas out of the homes.
Sure. So let me answer that one first. So I'm going to give you 5: environmental, social governance, and assuming this is allowed, we can even send a leave behind afterwards. But so environmental metrics that are really important that are in our portfolio today. These are actually the ones we publicly assess companies on. So is their carbon emissions profile? Is a deforestation profile? Is their water management? Is their deforestation profile, their water management? And there's actually what we call your emissions value chain. So it's not just your own company, but it's, do you consider environmental issues when you are doing your procurement? So then let's talk about the social ones. Diversity is really, really important. It's actually measured at 4 levels: the board, the management committee, all organizational leaders, and then the full workforce to see how diversity changes. There is a question about the right to organize. So do you have a freedom of association policy as part of our public assessment? There's another S factor would be a policy related to discrimination. And then let me jump to G. I think I only gave you a workplace safety, I guess, is another policy that's really important. And then on governance, there's questions about what we would argue is good characteristics of a board. So one is, do they have a separate chairman and CEO? There's a question on whether they have different voting share classes. So some companies concentrate all the voting power in just a few people. So that's called share classes. There's another question on what percentage or how long directors have been on the board. So what we want to see is regular refreshment so that no one gets stale and has a view. And that's, I think those 4 are probably the marquee 4.
Thank you. Sure. And since my mic wasn't on, for those who are listening or, in some form wanting to know about what this particular company values in terms of environment, social, and governance. That's our ESG that we hear all the time, but we don't have specifics as to the company's portfolio. Focus. Thank you.
I just wanted you to talk a little bit about the time frame, which my guess is this is just a maintenance issue. It just keeps going, but there's probably some things we can knock out early. I mean, and believe me, everything you guys said, I think the way you guys spelled out how complicated this is to be a good fiduciary and also to try to push environmental issues and all sorts of other issues. So I love the way you guys explained it. I like the information packet you gave to us. So if you could just give us some info on time and how you anticipate helping us and steps. You don't have to get too detailed. I just want us to get a little bit of info on that.
Yeah, no, thank you very much. And yeah, I mean, we because we live and breathe this, and we don't want anyone to get wrong-footed with too much of exclusions or too little. So the way we work typically with investors like yourselves is really get into the detail, like we kind of did a brief snapshot of that page 16, and help understand, where are those potential laggards today? If you asked us, we say anyone who's in the pure thermal coal mining, so pulling up coal to burn for energy usage, it's the highest carbon emission energy source you can think of. If most of their business is doing that, that's probably a problem. And you'll see them excluded across swaths of our portfolios as a result of that. So that's the starting point. And then we usually lean on to John and our global team of 16 plus folks on the stewardship team to start engaging with all of those folks. And so we typically approach this as small steps now, and then build this tiered bench of your next level actors, use engagement to try and keep them in the portfolio, unlock potential value, and then move on. But yeah, we would love to analyze, as we have, detailed parts of the portfolio, and then we can implement that, passively. We can use some of the tools on the active side. And I think really importantly, hopefully the biggest lead behind I can give you is we would own this with you. We would help you make it easy. We would come to you with ideas. It's not you send us a restriction list and we implement. We would live and breathe it because it's going to impact our ability to deliver your risk and return objectives. So if we see something new, like a tech divesting coal, we're going to call you up and say, hey, they might come off the list. Let's think about how to evolve that. And that's how we typically work with clients in this space.
Yes, Executive Director.
Yeah, thank you all for the presentation. This is excellent in terms of how we can actually move on our commitment to divest or engage by 2027. Do you have success stories on clients that you've actually moved from their current state to kind of where we want to go in the future? And is our time period reasonable?
We can probably all answer that. We definitely two types of success stories to mention briefly, starting from where you are and then implementing. And we do this with a number of large public plans. We do this with global plans, some of the largest sovereign wealth funds in the world, making those decisions. And as I think both John and Neil mentioned, it's important to tailor it to your objectives and your timelines, your risk tolerance. And a lot of funds out there don't necessarily do that. They're going to try and put you in something that's just what they've created, but it might not be perfect for you. So we try and help, fix the edges and tailor it to what you're trying to achieve, what your asset allocation looks like. And then I just mentioned the other story. We had someone who came with a massive exclusion list. They had already implemented it. They had hired us for an exposure, and we're trying to get them to add companies back in. So it's a much broader list, ExxonMobil's out, all of the oil majors are out today. And we're kind of saying, Exxon's on the, there's some that are on the watch list, right? But can we bring some of these back into your portfolio? And that kind of shows the credibility of our approach to kind of keep as much as we can whole while avoiding those long-term risks for you.
Yeah, the one thing I would add is, be very, very frank, the public plans on the coasts have moved already. So they are now living with decisions they've made 5 years ago and implemented a divestment list, and increasingly moving into this idea of very structured engagement and the interplay between engagement and divestment instead of blanket divestments. So you are at a very critical moment where you're going to do something, but you haven't implemented. Whereas, many of your peers in California, New York, are kind of twisting a little bit. It's very, very hard to undo. And so you have to that implementation moment is really critical. And I'm sure, your consultant I know is here too. I mean, that you just have to play it. You have to be very, very intentional as this unrolls.
One thing I was going to add is that we've been talking about the investment side. It's a very public commitment, and there's a lot of scrutiny around, public statements, right? So one of the things that's very important too is the reporting around that, right? Thinking through how can we prove, right, that we've done this the right way in a transparent manner, right? So what Dave spoke about, this bubble chart here, is an example of how you are able to explain how we get to a decision. That's one side of it. The other side of it is, on a going forward basis, what type of reporting do you get to be able to ensure that it's on the right path and in a way that people can understand? And that's extremely important. So the advantage here is that being a global firm, the standards in Europe are a lot more stringent, right? So you can imagine that having to produce a report in Europe, the expectations are much higher. And so if we can do the harder part, what we can do here is also quite interesting because we would build on that framework to be able to give something that is meaningful and easy enough to understand that when somebody raises their hand, like, yep, we've done this and this is why, and this is how we're evolving this list through time.
Quick follow-up. Yeah, just a quick follow-up question. How do you, if we hire you to help us with the strategy, how do you interact with the underlying managers who actually hold these companies?
Yes, hopefully they'd be proud to work with us as well because we're trying to limit the impact. I mean, this is the biggest thing that when we work with clients on these exclusion lists, you get a lot of feedback from your active managers who are saying, hold on, I've got a different view here. And so we kind of welcome the debate, send us back, who you think, let's really hone in on the list. And we've done that before, gotten feedback through a client from an active manager who wanted to challenge, a view on who should be on the exclusion list. But I think, with us being able to add a lot of, risk and return statistics, it'll hopefully make it easier for you to permeate that list and say, look, there's a lot of data behind these decisions, so maybe it's okay to narrow down the universe a little bit if it's meeting those long-term objectives. And I think that's where we've seen a lot of the success is adding a lot of credibility to that final list and then welcoming the challenge.
And thank you for that question as well, because one thing we want to point out is that this is a different relationship than what you typically would have with your investment managers. And we're looking more for a partnership. You can easily invest into a fund, and we talked about our fund as well, but we're also looking at an approach that helps you interact with those managers and create that united voice. But ultimately, at the end of the day, you have the reporting and you have the belief as a fiduciary that would maybe help you sleep at night a little bit better.
Yeah, I think to what Shauna just mentioned, one thing I was going to add is
let me ask one question and then I'll come to you, Lois, okay? Yes, we would welcome a leave behind, most definitely. Also, have you measured the timeline being swifter with investment, with your strategy of investment and engagement, or does it vary?
Yeah, I would say, I mean, it definitely varies. I mean, that typically it depends on the client commitment and then the risk tolerance. And that's one of the things that we can do. We were working with a client who's got a 2035 net zero objective for the whole plan, zero carbon emissions, or at least net zero carbon emissions by 2035, which is much more aggressive than the 2050 timelines that you see out there. And so we kind of show this is what could happen. This is what you'd need to do. These are how many securities you would not be able to hold to hit those deadlines. And then they kind of, okay, maybe we change our approach. So I guess the answer is we would definitely customize it to try and deliver whatever outcome you're looking for, and help you understand there's going to be a trade-off if you take some of these risks, and hopefully find the ones that'll be the good trade-offs, right? That's our objective. Find the ones that'll be the right ones to explore.
So 2027, is that realistic? Based on what
yeah.
you have looked at so far?
Yes. Yeah. I think there's probably enough on both sides that you could, yeah, absolutely. And we'd be able to support you in that.
What about less than 2027?
Yeah. It's probably, I mean, yeah, I would say possible. I would say anything is possible, from our perspective. You would have my undivided attention to work on it. I can tell you that.
Thank you so much, Lois.
And I just wanted to jump on one point. Oh, excuse me.
In case you missed it, actually, Neil.
Oh, thank you so much. So it's a brief one. As Shauna mentioned, in terms of the role that we would play, right? I think it's important to mention that we're also known for, in the corporate space, as an LDI firm, right? And what we do there is what we like to call, we play the quarterback role there, right? So effectively, LDI is liability-driven investing for corporate pension plan, right? So effectively understanding that the key benchmark is liabilities. So one is we're used to having that custom approach in relation to what makes sense to them. But the key thing is playing that quarterback role means that we own that in terms of the exposures across the plan, even though they have different managers, but we're responsible for the ultimate objective at the end of the day. And so that's the same mindset that we've been, known for several years, that we're replicating those mandates too, in terms of ownership and the processes we put in place to make sure that communication happens with the other managers, because that's critical. If you surprise them when they just bought that name, that could be a problem, for example. So yeah, that's the point I was going to make. Thank you.
Thank you, Vic.
I thank you, Chair.
Yes, Trustee Nelson.
Let's go back to my initial question. Okay, if Coltex has transferred into Glencore, now if it's a brief answer you want to say in terms of what Glencore is involved in, fine. If not, you can put it in your leave behind, if it's extensive.
Yeah, I would just say briefly, this is part of the reason why we really, when you do portfolio construction, you need to get exceptionally precise, because we've just taken the coal that was a big part of tech and moved it to a company where you don't see it anymore because they're so big. So you actually haven't changed anything. The coal mining that was happening is now just owned by a bigger company, masking what you were trying to get out of your portfolio. So, and that's something that we do analyze. And we look at Glencore. Is Glencore committed? What are they committed to? What does their carbon footprint look like in 20 years time? We happen to have Glencore on a pretty decent trajectory, and they're able to absorb those assets and transition them a little bit easier perhaps than the tech would have been able to do on their own. So net, we think it's a positive, but your point is critical. You can have it disappear over here and then it pops up over in another part of your portfolio. And that's something that we would, again, help analyze and craft. And as you target these objectives, ensure we're thinking about that knock-on impact.
Thank you.
That's a great point. Yeah, thank you.
Mind, I just have one more comment, and this is something we normally get hammered on during these meetings. So I just want to make sure it's very, very clear, our pricing structure. One of the reasons why I joined the firm is because we really do think outside the box, and we charge based on the fees we manage. We've been talking about working with your external managers. We do not charge any management fee. There's our oversight fee, nothing. It's only based on the assets we manage. We can do that at a passive structure. So our fees, I dare anyone to compare or compete against us on fees. I think you'll see a very low number, including our fund. This is not a typical situation that you would see with many of our partners.
Adding that, Shauna, that was really good. Okay, so any other questions? Yes. Trustee Barajas.
I'm sorry, I don't mean to belabor. I hope this is the final question. So you have 268 employees, and you said 88 are women and 85 are people of color. What's the overlap?
I can confirm that. One thing we, as an investment management firm, our numbers aren't great. I think in the industry, that's just the way it is. About 7 years ago or so, we started really implementing diversity into our hiring process. I do know our numbers of every new employee were around 50 something percent based on diversity, but I can definitely confirm the exact numbers so I don't speak out of turn.
Okay, thank you.
And I would also say just the trading on, we built it before we had any public funds trading. So we look at our overall model, and I believe our last numbers were hovering around 25% of all of our trades are traded with minority brokers. And so we'd exceed your numbers. But I will definitely get back to you on that. And I think if anyone else would like to jump in, again, we very much appreciate your time. We do understand this is a big, heavy lift. I hope we showed our background and this is what we do. We can be as aggressive as you like or take as much time as you need, but this is really what we're known for. And we'd be happy to join that process with you. And we have some follow-ups that we will make sure we do. And if I'm missing anything, team, please speak up now or hold your peace. We'll walk by any day, but next time we prefer without the rain.
Yes.
Yeah.
We'll order that for you. Thank you so much. This has been a very informative presentation, and we will be looking at all of this and doing our due diligence.
Great. Thank you again.
Thank you.
Hey, Shauna, good to see you again.
Yes, it is.
Good to see you or hear you.
Yes, I'm not there.
Bye all.
Bye.
I just noted that as they're leaving, I think trustee Rodriguez just raised her hand, so I don't know if it's a
Oh,
question.
Okay, no, it's okay. My comment was after they left. Have they left?
Oh, no, not yet.
No, they have not.
The next group is coming
The
in.
next
trustee.
group is coming in.
Okay, the only thing I was gonna say, I know they started approximately 10:05 and it's 10:49, so I thought they were gonna get like 15, 20 minutes, so we doubled it. My only concern is, I say it at every meeting, we've got to that time management thing that we pay $168 for a month needs to be turned on.
It
And I
is,
just want-
it's on, it's
It
on.
is? Okay,
And
just-
we gave everyone, if you didn't hear at the beginning, 25 minutes.
Okay,
They're
so
gonna be a little bit longer and 15 minutes for question.
right, just to make sure just that we give the same equal time to everybody. That's my only concern. Thank you.
Good morning and welcome to Chicago Teachers First Friday. With us today from left to right, we have trustee Barajas, trustee Vincent, trustee Nelson, trustee Washington, executive director Lenore, trustee Blackwell, trustee Price Ward, trustee Ochoa. Joining us remotely, trustee Rodriguez, trustee Riley, and trustee Woods, our chief investment officer, Fernando Vincents, our consultant from Callan, Brianne Weymouth, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Great. Thank you very much. Good morning. It's a pleasure to meet with you today. Thank you for the opportunity. I've spent time with several of you at this point, but by way of introduction, my name is Thomas Obaski. I'm a partner at Neuberger Berman, and I lead our public pension practice. I also live here in Chicago and serve as your RM. I understand we just went over the time period, and we'll ensure that we're tight as it relates to our prepared remarks and leave plenty of time for Q&A. So to be respectful, we'll dive right in. But with that said, this is your time and your meeting, so feel free to jump in with any topics, questions, et cetera, as we go. From my left to my right, we have Hari Ramadan, who's a managing director and partner at the firm. He is a portfolio manager and the CIO of our research funds at Neuberger, where he leads the investing activities of the firm's research-centric core and importantly, thematic funds. And then to Ari's left is Jeff Weil, who's the co-PM for this fund. He's been at the firm for 18 years. He serves as our senior research analyst covering metals and mining, and he's worked in this space his entire career. If you'll join me on page 5. A couple of quick things on Neuberger that are relevant to this product on page 5. We're 100% employee-owned investment manager organization that's solely focused on managing money for fiduciaries, for institutions. As you can see on page 5, we have a significant breadth and depth of our capabilities. Because of our ownership structure, we think and invest in the long term, including innovative strategies like the one we're here to speak to you about today. As we discussed, serving and spending time with U.S. public pensions is important to us. The U.S. public pension client segment is the largest and most important for us globally, with $57 billion in assets under management, 138 different clients across 48 different strategies. With that, I'll pause, see if there are any questions, and then turn it over to Hari, who will dive into our ESG investing at Neuberger and the strategy. Thank you.
Okay, we would, if you can go through the presentation and go through your slides, and then we'll have questions, but if it's a burning question, I have no problem with having
Waiting till the end.
one or two afterwards, but
Perfect.
we want to make you, give you the opportunity to utilize all of your time to tell us about your company.
That sounds great.
Okay,
Thank you.
Thank you, Trustee Ward. Good morning and thank you. Good morning and thank you all for meeting with us this morning. Thank you, Fernando, for inviting us to present to the board. My name is Hari Ramanan. Just a quick personal note. This is a very humbling moment for me. It's my first time speaking to you all, but I was the beneficiary of a very caring teacher at Lincoln Park High who afforded me to go to Knox College in Galesburg, Illinois. And so this is it's sort of a cool moment for me. So thank you again for your time. Let's dive into page 7. What we're about to talk, my partner and I, Jeff Weil and myself, today is an energy transition strategy, which is a pretty important pillar for what we do thematically at Neuberger. But let me start out by saying that it's a strategy that's built on the foundational E&S investing work that has been taking place at Neuberger for the last several decades. In fact, we, as a firm, launched the first 40 Act sustainable fund in the US. That was in the 1970s. But as you all know, and we can dive into questions later, sustainable investing as well as energy-focused climate investing has evolved over time. We can talk about sort of what those trade-offs and those points of evolution have been during Q&A. It is an extremely well-resourced effort at Neuberger Berman. We have 25 people dedicated to the engagement side that work closely with my team, which is comprised of 55 people on the research side that's split globally, so between the US and Asia. And from there, we drive what you see on this page, 3,400 plus engagements just in the last year. I think it's important to highlight the degree to which this effort is integrated, because oftentimes you can throw people at problems, but if it's not integrated with specificity, then they end up sort of going into ether. You end up with some proxy vote somewhere that has little repercussion on how actually governance takes place at some of the companies that we're going to talk about. Now, this work is thankfully well recognized by bodies such as the UN-backed PRI, where we've been consistently 5 stars for the last several years. The group I oversee, which is Global Research Strategies, is the thematic group that's built on this foundation. It's one of the fastest growing groups inside Neuberger. We manage about $11 billion today. Let's turn to page 8. Here I sort of lay out the idea that the energy transition space itself, as even probably evidenced in the last discussion with speakers, is there is a conundrum in this topic, in this rather large theme, and one has to sort of navigate that conundrum. As a theme, it presents, I think, the greatest risk of our times, but it is also the greatest investment opportunities of our time. So this has some trade-offs, and we'd be happy to sort of dive into some of that. Now, our discussion with asset owners over the last 2 years, including consultants, in fact, we spoke to, I believe, Callan a year ago, indicates the inherent conflict between maximizing risk-adjusted returns in thinking about things like tracking error, which are very important for, the annual servicing of annuitants, while at the same time complying with the Paris Agreement and moving to net zero by 2050. So there's some trade-offs out there. Now, tackling climate change itself makes investing in clean and renewable energy businesses an attractive long-term growth opportunity. However, over the shorter term, most of the energy sector's profits and return is likely to come from carbon-intensive businesses. Therein lies the conflict. So we believe engagement in carbon-intensive sectors, specifically around the area of energy transition, is a more effective way to resolve this inherent conflict versus outright divestment. If you turn to page 9, we think this challenge requires a new active energy investment approach, which we call the Energy Transition Accelerator. The mechanism we have designed aims for what we call the synthetic transition of an investor's energy portfolio and for the synthetic decommissioning of companies that are not committing to credible transition pathways. So you can think of this in either do-it-yourself company or otherwise we'll do it for you. In this process, we accomplish 4 things, and my partner, Jeff, is going to soon dive into the details of that process. We accomplish 4 things here. We participate in a responsible way in the economic value creation in the energy sector. We advance and hold these companies accountable to energy transition milestones. We punish bad actors, and oftentimes, in a strategy like this, we will punish bad actors along with asset owner participation, either publicly or privately. And 4, we actively divest or actively direct the $4 trillion of prodigious annual cash flows being generated by the sector to attractive areas in the transition economy. turning to page 10, in our conversation with asset owners and consultants, we learned that energy is approximately 5% of most institutions' liquid market exposure, and it's mostly sitting in passive strategies. We believe this was a dormant asset in this regard, and increasingly fiduciaries have been thinking about funding a strategy like this from this quasi-passive exposure. So we thought, look, if we could activate this dormant exposure to energy in portfolios, we could drive engagement on the underlying holdings with set timelines and metrics to drive change. And thereby, we would have the potential to add value both as fiduciaries or stewards, but also add value in making sure that that transition is being done in a way that is accretive to a portfolio's investment returns. We would identify and screen those companies with inadequate transition plans and redeploy capital from them to invest in decarbonization. Just before I hand it to Jeff, I'll ask you to turn to page 12. While it's myself and Jeff Weil before you today, we represent a much larger team. And the creation of N-Beta, which is what we're talking about today, has been a years-long effort, spearheaded by various stakeholders, both internal and external, including investment consultants, and has incorporated their feedback in its design. Providing solutions to the energy transition debate for us is a C-level priority. So we are beneficiaries of a significant amount of resourcing at the firm on areas, including on corporate engagements, which are both labor and dollar intensive, as you may know. With that, let me hand it over to my partner, Jeff, to walk through the investment process so you understand the mechanics of what we're talking about.
Thank you, Hari. Good morning, everyone.
Good morning.
So before jumping into my part, I just want to mention, so Jeff Weil, Senior Research Analyst at Neuberger Berman, covering the energy and metals sectors. I've been covering the energy sector now for 20 years, 18 of those at Neuberger Berman. And working on this strategy, Hari mentioned how many people at the firm this has touched, the thought leaders, people at the highest level. This is the most exciting strategy I've been a part of in my 18 years. And so there's many reasons for that. I'm excited because I really think this is a unique idea. It's new and different. At the same time, it can have an impact. And we just think it makes a lot of sense. So if you look on slide 15, Hari mentioned the 5%. The genesis of this fund was us taking a step back and saying, look, this is a controversial sector. We know that. And how can we come up with a thoughtful way to help this sector transition and to help investors, our clients and yourselves manage this process? On slide 16, this is the universe. Our strategy can be applied to all the US energy companies on the left side, or a broader index of global energy companies. This is where I spend my time. I mentioned 20 years covering energy companies, and I've been covering some of these names for that entire duration. Very deep relationships, contacts at these companies. Some of them we've owned for the whole time I've been in Neuberger. I'd say Chevron, for example. We happened to just meet with the CEO yesterday at our offices in New York, and then I flew out here last night. In fact, I actually think some of you were on my flight last night coming from LaGuardia. We met with the CEO. We're asking, and by the way, I meet with him 2 to 3 times a year probably, asking him direct questions about his climate strategy and engaging with him essentially whenever we want. But this was a planned meeting, and this just speaks to, again, our ownership of the company for as long as we've been involved and in the relationships that we've built. So moving to 19, how does this work? The first part of our investment process is to comprehensively rate, classify, and categorize these energy companies that I just mentioned. And we're doing this strictly from a climate perspective. We're using our net zero alignment indicator. It's a proprietary tool that we've developed at Neuberger Berman, and it assesses companies' net zero transition readiness.
We combine a quantitative process with a qualitative process. This has been, the team's been working on this for years now, and one of the challenges has been data in this space, and so sometimes the data is very lagged or it's not accurate. Bringing in the analysts, bringing in myself, this qualitative overlay, these conversations we have with Chevron, we think that adds a unique element to our process. We think it's a differentiator. We score all the companies and we make real-time adjustments. We don't wait for the third parties to tell us a certain company has moved lower. We don't wait for the data to show that emissions have gone up. We're doing this in real time, and I can give you many examples. One or two examples just from this year. You may be aware, BP and Shell, who had made some pretty bold climate commitments. Earlier this year, they walked back those commitments, some of them, not all of them. And what we're able to do is actively change their scoring in our system. And that flows into this strategy, which I'm about to talk about on slide 22. So we categorize and rank all the companies. And we divided them into 3 levels. Level 1, the way I think about it is just the climate leaders in oil and gas. And on our net zero indicator status, they're ranked as aligning or higher. Level 2, I think of as more middle of the road performers, the average companies committed to aligning. And level 3 is not aligned. It won't surprise anyone in this room. There aren't many companies in level 1. Most of the companies are actually in level 3, some in level 2. Why does this matter? The way that the strategy works is level 1 companies we're able to hold and invest theoretically over the long term, as long as they stay aligning on a net zero pathway. Now, I mentioned the BP example. BP has moved from a level 1 to a level 2. So depending on where you are with your categorization, that dictates the action we take. In level 2 companies, we do own them in the strategy, but dividends we get from these companies, we are, instead of reinvesting them in BP, we're not taking BP's dividends and buying more BP. We are investing those dividends in a clean energy portfolio that's part of this strategy. We call that a synthetic transition. We're taking their cash flows and doing for them what they're not doing. Hari mentioned that synthetic transition, and that's where it comes in. Level 3 companies, it's similar. We're also taking the dividends, investing them in the clean energy portfolio, but we're also divesting these companies over time on a schedule. And we want to work with our clients, you, on what that schedule should look like. I do have a hypothetical example I'll show you, but this can be customized in terms of timeline. But the other thing we're doing on a parallel path here is engaging. I mentioned that meeting with Chevron we just had yesterday. And so we're trying to get the level 3 companies, the climate laggards, we're trying to get them up to level 2. We're trying to get them up to level 1. And we're not going to be successful in all cases. We may not be successful in any cases, but we're optimistic that we can have an impact here. And by the way, we think this divestment policy, if they don't move up in our indicator, we're not going to own them anymore. We think that's going to be a pretty big motivational tool. And again, we think that piece of it, it's unique. It's not just rating them and saying they're not doing well. We are sending letters. We're doing all of that. But we're also voting with our feet here and taking that money, again, putting it in clean energy. So that's how the strategy works. And I know hearing it for the first time, there may be questions, and I'm happy to try and answer them. If we move to slide 23 real quickly, just a word about the clean energy portfolio. This is not a venture fund. We're investing in large, liquid companies across a number of different subsectors and geographies. We estimate the global clean energy sector right now makes up around 600 billion of equity market cap. It's grown over 6 times in the last 10 years. And really, this is the long-term opportunity that Hari mentioned. We see that. It's going to take some time, and hence this transition. This fund is meant to transition, I think, like it's going to play out really in real time here. My last slide before I turn it back to Hari, slide 25. Now, this is a hypothetical of what a portfolio could look like. Granted, this is, I know, on a much longer time scale than I think you guys are interested in, but as I mentioned, it's customizable. But the point we want you to take away here is the clean energy sleeve, it doesn't have to start at zero. In this example, it does start at zero and we take the dividends and it grows over time to almost half the fund. The level 3 companies I mentioned start around 30% of the fund and go to zero by the end of the fund. And that's the transition. And again, customizable. It's called the Energy Transition Accelerator. We can accelerate this. Let me turn it back to Hari for some additional remarks.
Yeah, just jumping off of this page itself, I think the point is acceleration is determined by the vector of engagement. You know, we are going to be really active. That's what we do. And so if we are able to get traction with these companies in objectively measurable milestones, then we give them a little bit more rope. If not, we move. But when we move, we have to do this in a way that is thoughtful, because a portfolio like this takes on tracking error. Tracking error, these are, you know, certainly trade-offs to consider. In a year like this year, for example, the energy sector is flat. The clean energy sector, so to speak, is down 30%. Can a fund of an endowment that has 5% of its liquid assets in the space take that degree of tracking error? Let's say if one decided tomorrow to move half of this portfolio to clean energy. So what does that mean? What are the trade-offs? What are the implications? Those have to be determined as you're thinking about the acceleration of that transition. Let me turn to page 31, because I think the strategy comes to life. You've heard the mechanics here of the reclassifications and how we would almost formulaically make this transition. But what drives that is day-to-day engagement. Jeff referred to Chevron, but on page 31, you get a sense of Jeff, as well as my other partners, Ron Silvestri, Jared Mann, working in these spaces, spending time on these types of engagements. And if you look at the right side of this page, I mean, the topics of engagement are not buybacks and governance, the typical asset management areas. They are areas of material, climate, energy transition related topics. You'll see, for example, and one of the things I'd highlight is, why is this engagement sort of important? Because when we have $450 billion under management, we have a voice at the table. And the companies we engage with are often the big dogs, so to speak, right? They're very large caps. They are sometimes pretty poor offenders of the climate compact that the world generally has made. But there is a reason why they come and talk to us, because as an active manager, we have the ability to, you know, shape sort of the, you know, how these folks are ultimately getting compensated. But importantly, we engage with specificity. And this is where I think going against passive is an interesting area, right? Now, this is a list of our select engagements just in the last year, where our work, take for example, a company like Conoco, it's around oil field strategy in a climate sensitive region like Alaska, right? So, or holding them accountable to methane detection milestones. You know, what I would say is, if you look at methane detection, it's a material area for carbon reduction, for emissions reduction. So if you turn to page 32, what we then do is the work we do is actually directly with the boards of these companies and often in partnership with asset owners. So one question for you all to determine is, to what extent would you like your voices actually heard, or would you like it to be on the quieter side? We do these things privately. I mentioned methane detection in the last page, and here you can see why this is so important to curtail and measure. Because, for example, I mean, it has, you know, methane has, you know, 25x or is 25x as potent as carbon dioxide at trapping heat in the atmosphere. So methane attack, you know, for every 25 cents of, or every $1 of carbon dioxide we're thinking in our heads, think $25 is methane. So what do? We worked with Conoco, we worked with Devon, we worked with Pioneer. Altogether, it's $200 billion right there of market cap in the last 2 years, and got them to measure and reduce methane emissions. In my opinion, in our opinion, methane reduction will do more for the Paris Accord and getting us to net zero than Microsoft can in the next decade. And I know we all love Microsoft for the great cloud, you know, services that it provides. Now that's a certainty. So I'll ask us to turn to page, very quickly to page 36. I think in the last conversation or discussion, I did hear some comments or questions around sort of examples of what do we actually end up doing with these companies when it comes to proxy voting. And one of the issues that we take with passive here is that I ask sort of tongue in cheek, can we actually proxy what we preach? Because oftentimes I don't see our closest peers doing that. We've been the first manager to actively publicize our proxy voting in advance. And as a large manager, we've not been afraid to take on the big emitters. So here you will see, you can look at sort of specific proposals in the proxies, Exxon, Chevron, Coterra, Valero. A voting record on substantive topics can be quite different from passive index funds. I mean, this is just a visual. You'd sort of see where we are on those proposals. And just look at the ExxonMobil's reporting on methane emissions. BlackRock against, Vanguard against. I mean, there are proposal 9 for Chevron, actually reporting on just transition. BlackRock, State Street, and Vanguard against, abstain against. I mean, to us, this is quite different from what has been sort of the overall spiel that you might hear from some of our peers at sort of a C-suite level. So turning to page 37, in conclusion, we'd like to make the case that in order to accelerate transition, we need carbon-intensive sectors such as energy to be held accountable. Without sectors such as this making significant contributions, there's no amount of avoidance that will win the war on climate. This is because the world remains significantly dependent on these industries in our lifetime. Global emissions actually are up 10% since 2019, despite all efforts to change how we consume products and services. Despite a global COVID-related shutdown, we're up 10% from 19. Now, to achieve Paris 2050, folks, we need to be reducing emissions per annum by 7%. By 7%. So look at the difference. And the only way we can do that is to bring these big emitters to the table. So with that, let me conclude and open this up for questions.
Yes, Trustee Barajas.
Hi, I'm Trustee Barajas. I have 2 questions for you. Let me get my glasses on, sorry. So I guess the first question is, you have 80 billion invested in private equity globally. Are you trading investments for carbon credits?
Yeah, good question. So in the private sleeves that we have, so that is not entirely, it's our overall footprint in private equity. But we are actually not trading carbon credits in the private side. We do this at the firm level, but we're not doing carbon credit trading on the private side under that 80 billion. There have been some talks about doing some custom solutions there, but we're not actually trading. We're not in the carbon credit exchange market.
Okay, and the second one is, so you indicated that you punish bad actors.
Yep.
Right. But according to majority action, out of the 31, 97% of the time for US companies, you voted to keep the directors. And then out of the 31 companies where you could turn over part of the board, right? Because they indicated these are bad actors. 27% of the 31, you voted to keep those boards.
Right. So
it doesn't seem like punishing bad actors.
Right. So I think one point here is that when I was referring to punishing bad actors, I guess it's a comment made on what we're doing in this particular strategy, meaning to divest from those companies and thereby increasing their cost of capital. In terms of so what punishing bad actors in this case is to work on the proxy side and then move away. In terms of how our voting stacks up, I mean, I think you're referring to sort of our public voting record on the big emitters. Is that fair?
Right, because you're a big company, right? You have a big effect in terms of keeping those boards and those directors. but your record doesn't show that you flex your big muscle in that sense.
Fair enough, but keep in mind that we're voting individually on certain proposals as opposed to necessarily across the board in terms of voting to continue with management or not. Does that make
Right,
sense?
but if the management is making bad choices, right? The directors and the management making bad choices, right? As a big company who could have large impact,
right?
I would hope that you would take the step out and say, hey, you know what? We're gonna flex our muscle and say, no, I'd like a director change.
Jeff?
I'd say a couple things here. A lot of different constituencies at Newburgh. This strategy is the climate strategy. And we're here to start raising significant capital in it so we can flex on the boards. We have to consider a whole host of things when we're voting. We can't just consider climate as a firm, right? This strategy will just consider climate. And so I think what Hari's saying is you've got different pockets of investments and different goals at the firm. And, sometimes it can be as simple as if a stock is performing or a company is performing, it's hard to vote against a board. But again, this strategy is going to take an aggressive stance. We're looking for the capital to have muscle behind that right now.
Yeah, and I would also say, I think Trustee Barras, it's a little bit more nuanced than voting with or against the board completely. I think we go down to the proposal level because oftentimes these boards, we need them on our side to make that change. Because you take the board out, the other person coming in, oftentimes can commit to the same actions. So you've seen that in some instances. I mean, for example, you look at after all the changes that took place inside ExxonMobil, in our case, it's still considered a level 2 business. Right? It's not even level 1. So I think activation through just changing management may not be the answer to actually fulfilling sort of energy transition objectives. It's about getting our way in certain proposals, and in return, you might give more. So one of the biggest issues here is stock comp for US-based teams versus non-US teams. So it's one of the things that we have to use as a carrot and stick to work with them on energy transition. So it's sort of pick your poison.
Trustee Price Ward, Trustee Riley had her hand up.
I took it down. Did you hear?
Oh, I'm sorry. Thanks, Sonia. I'm really focused on the slide 24. I'm just looking at all of these fossil fuel, firms are in your portfolio right now. And so since we're trying to get away from fossil fuels and we've voted on that, et cetera, et cetera. So that's a concern with me right now.
Yep.
And I'll just offset that because I was looking at page 23, and I won't go into that now, but a lot of this on page 23, the different areas that you're into, the hydrogen, et cetera, nuclear power, it's kind of exchanging one for the other on that page. Anyway, so let's focus on one at a time. Okay.
So fair enough. So in terms of the energy sector exposure that we're talking about, that's fossil exposure. That is, you will also see on slide 25, that's the exposure that you're bringing down. But if you bring this down without engagement, you're actually the question is, are you actually doing anything about emissions? Just because you don't, you need to be involved to be engaged with them. If you bring this down at a very fast pace, you're also increasing tracking error in your portfolio, which might mean that you're taking on some more nascent technologies on the other side of the equation that you may not want just yet. The other thing I would sort of say is that when you look at the topic of transition, the biggest companies that are going to make the biggest impact in this transition is going to be some of the existing stalwarts. Right? BP and Shell, for example, Occidental Petroleum, which might be viewed as a bad company, they are going to be the largest, they're going to have the largest carbon capture footprint by 2028 in the world, meaning they will do more for carbon capture than, again, a Microsoft, right? Which is not necessary, which is a view avoiding them. So there's no other way but to recognize Occidental as a company that is actively plowing into into carbon capture to facilitate sort of, that move towards reducing emissions. Otherwise, you're not going to be able to get anywhere. We're going to be continuing to increase our emission footprint.
Right, and that's why I mentioned that we may be moving away from these areas of fossil, but then we're going into other areas, that may be equally important.
Yeah, but I would just clarify that when you look at the other areas, whether it's solar or green hydrogen, so hydrogen specifically, we're talking about a sort of green hydrogen as opposed to what's considered gray or brown hydrogen, or energy storage. These are, in our opinion, these are going to be, from a scope 3 basis, they're actually going to be negative. So they are creating the usage of products that will actually reduce emissions.
I don't know, I guess looking at what is out there now in the public and science, we're not there yet. Okay, so, all right, do you agree to that?
Right. I mean, but I think if you look at whether it's a solar company or a wind company, is your point that you are.
Oh, no, I'm not talking about the solar and the wind, because we know that that's working.
Sure.
I'm talking about the areas that are in dispute right now, because they're not where they should be. So, but anyway, I guess that entails a lot of discussion, so.
Sure.
And that's the reason
Okay,
for the
so-
transition too, ma'am, right?
For the transition. Okay, I have trustee Vincent and then trustee Ochoa.
So, I know we're saying that the.
I did put my hand back up.
Yeah, can you put the mic up closer?
Actually noticed the cord is too short. Now I unplugged it. No, I can't. All right, you can still hear me. All right, the cord is short. I'm sorry, we're talking about the carbon emissions and the cord is just short. And I'm sorry, you mentioned something about methane.
Yeah.
And I know methane emissions come from different industries. So how, and again, based on what you're saying, you think that'll be, it'll be a bigger issue long-term than carbon. How are you addressing that, I guess, with the trading? Are you, yeah, because I understand what you're saying that you can use your muscle to make change. How are we getting methane, I guess, on the list of something to be looked out for?
Sure. I'll ask Jeff to elaborate on methane. I think my only point is that methane is more potent than just focusing on carbon. So, but it's in the same, it's in the same genre. It's just a more potent part of it. So.
The only thing I would say on slide 19. We list, so some of the drivers behind the ranking system. It says there's 6 sub-indicators. Methane emissions is captured in almost all of these. And so specifically emissions intensity. So when we evaluate these companies, it comes through in their ranking, their methane intensity essentially, and whatever their plans are. Like we mentioned, some of these companies that have joined this partnership, that would all be reflected in the ranking system.
So I think what is hard to communicate to your potential clients is just, this is a heavy lift. There's not a quick shortcut to it. So when I look at your slides, I think it's 27 and 28. Yeah, I mean, it's tough because you're trying to get people to stay with a company and force them to change. Because if you don't have a voice, if you divest, you don't have a way to motivate them. Because the examples that we've been told today is they just sell off something to another company and then they say that they're clean, but which actually can have some effect. But if you're really going to want to create change, you actually probably, you have to still stay in the game. And then when you invest with them, but the problem then is getting your voice to be listened to by that company. And that's the hard part. And that's Jeff, that's what you were talking about. Having a consistent relationship with them where you think that you can motivate them to start moving. just divesting doesn't get you there. So I think that's the hard thing for us to accept. Is there anything you want to explain on that and how you get that traction, or how you get there, why it's a slower process than people want it to be?
Yeah, it's a slower process than what you'd like it to be, is because we actually saw what fast looked like. In the last decade, lots of asset managers, as was mentioned in the last call, completely avoided it. You ended up with climate-friendly strategies or climate-friendly mandates move away and move heavily into tech, right? So owning Microsoft is not panacea, because our emissions as around the world has actually just sort of gone up. And the other thing that was exposed in moving so fast is what you're exposed to in avoiding a sector like energy is from a tracking error standpoint, from the ability to serve, the distribution, so to speak, for a pool of assets, becomes tricky, particularly in periods like 2020, what happened in 2022. Tech burst, energy was up. So all these heavily, so to speak, climate-friendly MSCI AAA rated strategies heavily underperformed the market during that period. So there's some accountability for that, depending on strategies, tracking errors. And then the other thing is you're seeing something like this in a more nuanced form evolve this year, which is, let's say you say Microsoft is not the answer, but solar and wind are the answer. Well, in that case, can we take on the economics of solar and wind relative to the economics of, again, diversified energy companies in a year like this year? Actually, what you've seen happen is solar and wind has imploded this year. And lots of people would say in the long run, it's an opportunity, and that's fair. But the reason they imploded is not because of a hiccup. They imploded because their economics were significantly impacted and are expected to be impacted for some period. So the question that I ask us collectively is, how do we feel about that? I mean, in order to be sustainable, we need to get to a point where we can be sustainable. So the economics have to be sustainable. So that's one of the things that you've had with, vast moves. So for example, your average climate fund this year is down 35%. And in that, there's lots of dispersion. I mean, areas like hydrogen, as an example, have had big resets. Now that might be an opportunity, but that's why transitioning has to be done in a measured way. Because if we do this at the wrong price, do this with sort of more mission criticality than necessarily reflected in reality, then you're going to be taking on, I think, tracking error as well as, frankly, just absolute returns. I mean, you're going to lose points in doing that.
Let me add to that, in particular on the tracking error point, because it comes down to the board, the staff, et cetera. If you go back to 25, you're kind of picking where on this path you want to start, right? You don't have to start all the way over to the left side based on those numbers there. You're picking where you start. So there are two toggles that you have. One, you're picking where you start on the glide path. And two, you're deciding as a board, as a staff, as a consultant, what is the tracking error that we're willing to take against regular energy? So when you have those two levers, you then can decide where along the path you want to be based on your own goals as well.
And a representative example like this was to sort of say you start at zero because you give yourself 3 years, you give the collective group 3 years to say, look, my engagement worked, didn't work, and at that time, the punishing starts. But you can also start with, trust me, but you can also start with 20, 30% starting with clean, but then the trade-off there to the board and the staff collectively is the tracking error will move up to maybe 200 basis points, as opposed to today, it is, 10 basis points. So the question is, how do we feel about that? And, period like this, you might actually say, look, I'm comfortable with that because a lot of that clean energy pain has been taken. And so the board and the consultants can feel comfortable doing that.
And then last point, this is why we think you have to be active in this space, because of the amount of picking the winners and the losers because of the dispersion within the space.
Okay, I have another trustee, Trustee Riley. Trustee Riley, your question?
Yeah, thanks. I was muted.
Okay.
It seems that in Illinois, we have kind of a unique situation in that we have coal mines. And there's that segment of the Illinois population who is not in favor of some of the things we're talking about. How do we deal with that?
Yeah, that's a good question, Trustee Riley. You talk about coal mines. In fact, I also see that the holdings today in the fund has coal exposure. At Newburgh, that would be considered below even level 3. So there will be a desire to move away from coal very, very quickly and actually take on that tracking error. Now, this is for a clearly for a strategy that is having a mission around energy transition. So coal has some very, very good economics that associated with it, but it is so far removed from sort of a transition plan. Like that will be the type of holding that we would look to actually immediately or very soon to immediately divest from.
Right, but then the politicians in Illinois have a different view, some of them.
Jeff?
Trustee Riley, I would just say, look, you've hit on a very difficult, complex topic. It's similar to the folks in West Texas who say, if we stop using oil, what happens to us? And so I do not have the answer for that. All we're trying to say is, I think, and this ties into your point, Trustee Ochoa, the timeline here, right? It's just going to take a little bit longer, right? We've got to build up these other sources of energy, these cleaner sources of energy. There is a large incumbent, the fossil fuel sector. It's used globally, virtually everywhere to sustain modern life. And displacing that is just going to take time. We're not saying slow that down. We're saying let's do what we can to speed it up. But and so again, I appreciate your question and because that's for someone much smarter than me to figure out.
Right, but it is a reality.
Yeah, and you can see this in a fast-forwarded form, where Europe actually is politically devoid of coal, but based on the last crisis that they just had with Russia and Ukraine, they are now the biggest importers of a company by the name of Glencore, which is importing or exporting Colombian coal into Europe. Now, it just goes through a few other intermediaries, but Europe's formal stance is they're divested of coal, but they're getting the power from coal. So that's the unfortunate reality in which we live.
Okay, we'll take a final question. I'm sorry, Trustee Riley. We are well above time, and I'm taking a final question. Final question from Trustee Washington. Okay, he has reneged his question. So we do need to move on. We're about a minute over. So thank you so much for.
Thank you very much. Thank you to the board, to the staff, to Callan. We appreciate the opportunity. Have a good weekend.
All right, you as well. Told you I'd never forget your name. I did a lot of work on that in my graduate studies with John Dewey, on studying John Dewey.
Okay, good morning and welcome to Chicago Teachers First Friday. With us today, from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, joining remotely, Trustee Rodriguez, Trustee Riley, and Trustee Woods. Our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Brianne Weymouth, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you, and thank you for the introduction and the opportunity to be here today. It's great to see many of you again in my new capacity at Viridian Global Investors. We are a relatively new firm. but we are very focused, and we are focused on climate action and climate adaptation and mitigation. So very appropriate to be here today to help discuss some of the options around public equity investing in climate action and sustainability. We think we've come up with something that addresses all the needs of institutional investors that are trying to solve two things. The first being, how do we make impact and how do we drive sustainability from a climate standpoint? The second is fiduciary responsibility. You've got retirees that expect to have retirement funds available when they are in retirement. And so we think we've got a solution that meets both those objectives. So we're happy to be here today. I'm happy to be here today to speak on the topic and hope to have an opportunity to introduce you to the rest of the team down the road. You know, it's interesting, as a climate-oriented investor, you can imagine we get a lot of data, we see a lot of charts, and we try to synthesize all that information and really develop a clear perspective. For me personally, one of the charts on page 2 is one I came across that I just think is a great visual depiction of kind of what's happened with climate and temperatures around the world in this, from a pre-industrial standpoint. If you look to the left of this chart, you can see kind of the year you were born and how much temperatures have changed over time. For 70 years is how this is used. If I think about my daughter being born in the year 2000, in 2070, it's going to be a very different place. And you're already aware of that. That's why we're having this conversation. And I appreciate kind of the thoughtfulness that has taken place here at CTPF to move forward. The good news is people have been thinking about this for a long time, decades in fact, and trying to come up with an understanding of what the problem is and what are the solutions. And technologies that have been developed are well in place today, and they're great investment opportunities that exist as a result of government subsidies, government policies that have pushed the adoption and innovation of these technologies. So we're delighted that we're at a place now where this is in the mainstream and we can make it available, and it's a tremendous opportunity for investors. And let's not mistake, this is a very large economic risk to investors, just like the coal story we heard previously. Stranded assets is a real risk, and how does that play out over time is something I think all investors need to think about. But on the flip side, we believe this transition really represents a tremendous economic opportunity for investors as well. And in fact, our PM would say it's one of the most attractive investment opportunities she's seen in her 30+ year career. A lot has been said about net zero, and net zero is a target for sure. But we think net zero is kind of insufficient, and it's certainly not the ending point. Strategies that are focused on net zero can be a little misleading, and they may not be actually having a true impact on what you're trying to accomplish. As a result, we've adopted the EU taxonomy to think about the problem. And you can see the chart here on page 3 shows the current emissions trend line, which is the red line that goes up from left to right. We're trying to achieve net zero in the middle of the page, right? So our carbon footprint remains unchanged. We're probably not going to meet the 1.5 degrees that everyone's targeting. So we actually need to go beyond net zero and get net negative. Beyond net zero is what we call it. And the companies that are in this space are the companies that are helping the multinationals, the Fortune 500 get to net zero. That's where we're focused. These companies are the opportunity in our minds, and they're the ones who are going to help us achieve net zero in the aggregate on a global basis. The next page on page 4 is more the same, but evolving technology. If we get past that 1.5, we're going to have to start removing carbon from the air, as we know. And so net negative emissions is what many companies are working on, and that will be something that we'll be investing in the future. Where does where do emissions come from? I know there's been a lot about energy transition, and clearly emissions come from the production of energy in a lot of different ways. But in fact, if you look on page 5, it's only about 73% of emissions. There's a lot of other things that are driving emissions. Agriculture is probably the next biggest one. I think I heard the word methane raised a few minutes ago. Certainly, solutions to offset methane is a huge issue that comes from agriculture. Waste and other industry like cement production, other things like that are also sources of emissions for us for greenhouse gases globally. In fact, globally, on page 6, you can see that over trillions of dollars are being spent to accelerate the energy transition, both renewables and to drive decarbonization. From 2020 to 2022, $1.3 trillion was spent globally. This year alone, 2023, $2.8 trillion is expected to be spent. And on a go-forward basis, $3 to $5 trillion a year is expected to be spent on these initiatives for the next decade or more. It's a big investment, which means there's a lot of opportunity as well. And frankly, the companies that are developing the products and facilitating the transition are really poised to capture a disproportionate amount of the global GDP. Whether you call it secular tailwinds or a multi-decade megatrend really doesn't matter. This is a secular growth story, and it will continue to be bolstered by generational priorities, government subsidies, and a heightened focus on climate change. I think, what's interesting about the policy in particular is that we have different administrations with different opinions, and we've seen those administrations come and go. And the reality is, at the end of the day, this is a global initiative, and the U.S. is a leader in the globe, in the global economy for sure. But these tend to be speed bumps in a long-term secular story that is this energy transition and decarbonization story. This awareness is not just here, but across the institutional investment arena. And increasingly, we're seeing pension plans like you all make allocations, but they're making allocations to managers that have demonstrated knowledge in the space and the ability to drive impact. And that's driving impact without compromising performance across asset classes, private equity, infrastructure, and public equities, to name a few. In the public equity space, perhaps oversimplifying, but when we think about it, we look at the different product offerings in 3 categories. On page 7, we've kind of broken them out, and perhaps we shouldn't put all these names on here because it is what it is. I think you can find this information, it's all in the public domain. But nonetheless, the first category is incidental low carbon emitters. I was with a firm in 2013 that was in a portfolio review, global equity portfolio with a public fund. And we went in talking about our performance, and they asked us, do you know what your carbon footprint is of your portfolio? And I looked at the portfolio manager looked at me, and we kind of shrugged our shoulders and said, nope. And they proceeded to tell us that they'd done an analysis on their portfolio, and our portfolio footprint was 20% of the MSCI world. We're like, wow, that's amazing. We are rock stars. But why was that is the question. The reason why it was so low was because we're invested in technology companies, consumer staples. We didn't own any mining companies, manufacturing, industrials, and that's where most of or utilities, and that's where most of the carbon is coming from, energy, right, and in manufacturing. So we call these incidental low carbon portfolios because it's really not by design, it's just more a function of where these assets are allocated. So are they solving the problem? Nope. Are they avoiding it? Perhaps, but certainly when you're looking at portfolios, know that there are different ways to look at the analytics. And if you're 20% of the MSCI world, that looks really good. But are you doing anything from an impact standpoint? Likely not. The second group is climate conscious strategies. And those strategies are looking at global multinational companies that basically have identified those players in global industries that are becoming better players. They're intentionally trying to reduce their carbon footprint. Those companies are doing the right thing, but it's going to take some time. And guess what? They're going to need product to do it. They're going to need services and technologies. And that's the third group. And that's where Veridian operates. True impact. The companies in which the firms here are investing are companies driving the change. They're the companies on that blue line, the net negative companies that are actually helping multinationals move to this net zero framework. These are the companies that are getting a disproportionate opportunity and showing a tremendous growth opportunity for investors like you all. But when I say impact, what do I mean by impact? How do you measure impact? Is it just a number and a footprint? Well, it can be. So if you look on page 8, when you think about our portfolio, in the absolute sense, the annual Scope 1 and 2 emissions from our portfolio companies on an annualized basis is 180 million metric tons of CO2. Sounds like a very big number, and it is. These numbers are very large. However, the products and services that they are delivering to the market creates a category called avoided emissions. And those avoided emissions are 720 million metric tons. That's a ratio of 4 to 1. So on an absolute basis, they're 4 times their footprint from a savings of carbon. So what does 720 million metric tons of CO2 look like? If you go to page 9, it's the equivalent of the annual emissions produced by about 160 million cars in the US. That's about half the auto population here in the US. 720 million metric tons of CO2 is equivalent of 140 million homes, or powering those homes for a year. If you think about it a different way, when you think about sequestration, removing carbon from the environment, 720 million metric tons, to remove that from the air and the environment would require a forest the size of Alaska, California, and Texas combined. And these are huge numbers, right? But this is real, and this is what's making a measurable impact. Another way to look at it is on a revenue basis. So what is your carbon output per dollar of revenue? This is known as intensity. Intensity is a great measure because you can really equalize and compare apples to apples. Our portfolio at the end of September had 37% less carbon per dollar of revenue relative to our benchmark. Scope 1 and 2. On Scope 1, 2, and 3, 28% less. So this is impact, it's measurable. We've hired a third party to create these statistics for us. They're independent. We use Sustainalytics, we use ICE or Gentum, well-known players in the space. And this is wonderful. What's even better is that we can have this impact without sacrificing returns. So if you turn to page 11, we ran an analysis of our portfolio against all the global equity, all cap managers in eVestment, commonly used tool by most institutional investors in North America. Strategy was launched 4+ years ago, and you can see the 2 strategies we have are the blue squares in the top left. That is our risk and return profile. Materially higher returns than all the peers, clearly higher than the benchmark. With some more volatility. This is kind of an emerging growth space. And so there is more volatility, and you do have politics, and you do have interest rates, and you do have more volatility that comes with a strategy like this. But across 4.5 years, it's delivered quite nicely. If you look to the right, the chart shows upside downside capture, capturing about 135% of the upside market return, while only capturing 80% of downside. This is the kind of ratio you want when you're a long-term investor. When we drill down a little more on more specific climate-related strategies to see how we did against our peer group, more specifically, it's the same story. You can see the 2 blue boxes meaningfully outperforming the peer group with more volatility, but again, the same story with upside downside capture ratios that are very attractive to investors. Why don't I pivot for a second and talk a little bit about Viridian Global Investors. So Viridian Global Investors was established in 2019, and we're a majority woman-owned and run firm. We were founded by Ariane Mahler, who is a 30-year veteran of investing institutional dollars. She also happens to be a pioneer in climate investing, having launched one of the first net zero funds for La Française in 2015. The mandate is very clear. It's twofold. Let's generate great returns for our clients and deliver meaningful impact as we do it. And I think we've demonstrated over the 4+ years that we've been in business that, in fact, that's exactly what's happened. Her valuation-sensitive framework for investing is probably something you're all very familiar with. There's some process pages in the back. I didn't even put in the body of the book because they'll look very familiar to you. It's traditional, institutional, valuation-sensitive investing with the overlay of climate. How do you pick the best companies and buy them at the best price? And that's what she does every single day. And that's why she's not here today. She had some conflicts with some other things in the portfolio. So, you know, I would love to have a chance to introduce you to her. I think you'd be quite impressed by her vision, her investment prowess, and what we're delivering to institutional clients. We currently have different vehicles available, and we've partnered with Northern Trust here in Chicago as our middle office and back office provider. They also do our outsourced trading for us. Why don't I pause there and see if I can answer some questions?
From the floor at this time? No. John?
Thank you. Just a quick question. One of the ongoing problems with ESG investing has been benchmarking. Just how do you benchmark and kind of take out some other factors so that you're really measuring the return impact from actually, you know, putting these protocols in place? What do you guys do for benchmarking?
So for benchmarking, we are looking at just pure absolute numbers in terms of the absolute carbon footprint. So for impact, carbon impact, we're looking at benchmarking against carbon per dollar of revenue. So that's very easy to measure across different industries and sectors and see our relative strength or weakness there. And then from a performance standpoint, we benchmark against the MSCI World. We don't think we should be special in any regard, you know, and not be required to deliver the returns that you all are benchmarked against as a plan. Does that answer your question?
Yeah, I mean, it's kind of status quo. I mean, you know, one of the problems, again, this is the topic for 15 years. I mean, clean tech. It's just how do you measure the part that's just part of, you know, systematic, unsystematic risk, taking out other factors and measuring, you know, getting down to what am I getting out of the investment by implementing these protocols, as opposed to I'm just in a company that happens to do this and I'm just getting the benefits of a lot of systematic and unsystematic risk.
So one of the things that we did, and one of the reasons why we decided to launch the firm, was we looked at the portfolio and we said, is this systematic or is this actually intentional? And through FactSet attribution software, stock selection actually is the reason why we've outperformed how we have. Actually, over 90% of the attribution would suggest stock selection, as opposed to being in the right industries or the right sectors or the right geographies for that matter over time. For us at Viridian, it's stock selection that's driven our performance. So we use all the same tools that all your institutional managers use to make sure that we are exactly in line with what is expected, and we can understand what's driving the performance of the portfolio, as well as the impact of the portfolio. On page 29 of the book, we also take ESG more broadly very seriously. The portfolio and the companies that we invest in tend to be fairly good citizens because of the space they're in, but they're not all. Our head of impact, a gentleman by the name of Paulus Ingram, was with APG, one of the largest Dutch pension plans, for about a decade, and he helped them develop their ESG program and measurement. He is now leading our ESG program at Veridian, and he is, when we have a company that maybe isn't falling in line and is not a good ESG player, he's engaging with all the largest pension plans in Europe and building classes to put pressure on companies to change behavior. So we're just a little company, but we've got a very big reach because of Paulus's relationships globally with a lot of these large global pension plans out there that are very focused on this space as well.
Yes, Trustee Ochoa has a question.
Yeah, there's a lot of good info in here. Could you elaborate on, I think it was just page 12, and I think the other one was 19. I'll double check 19. Yes.
Yeah, so 12 is really a risk return view of the performance of the portfolios over the 4+ years that we've been running them, which show kind of our relative return and risk, as well as our upside downside capture against both the global equity universe and eVestment. So all the other managers that are out there offering global core equity strategies, and then more specifically, a more narrow peer group that we've identified that invests in a similar way that we do. So that's that page. On page 19, this is really, when I was talking about valuation, this is the mechanics of what Ariane does as a portfolio manager. And this informs both the stocks we buy, as well as our sell process and position sizing. Essentially, she comes up with a risk-adjusted target price for every security that goes into the portfolio. And as it approaches that risk-adjusted target price, we're trimming. So that's our sales process for getting out of names and ensuring we don't fall in love with stocks. A stock that's a 3 to 5 position will have upwards of 50% upside expected in the portfolio. So that's how this is constructed. And as that opportunity and the return expectation for that stock declines, it'll move to a 2 to 3, 1 to 2, and then we'll exit the position. I think what's unique about Ariane is she looks at a whole lot of things. Obviously, she's doing all the fundamental work. She's been an analyst for 30 years. She knows her industries inside and out. She does not meet with management because she does not want to be influenced by their charming personalities. She's very independent in what she does and how she thinks, and it's implemented in the portfolio every day. It's very actively managed, and she tries to keep the barriers around her so she's not unduly influenced by outside forces.
Executive Director.
Yeah, thank you, John, for your presentation. Just a specific question for CTPF. We have $380 million in coal, oil, and gas exposure. How would a client such as us implement a strategy like that, and how can it help us either be carbon neutral by December 2027 or fully divested?
You could give all the money to us because we don't have any of it. I think it's a big challenge. There was a conference I was at recently, a group called Quantum out of Houston, and it was a very thoughtful presentation about energy transition, and energy independence, I think, was really the underlying theme at the end of the day. This is not a light switch that's going to get thrown tomorrow. This is a long process. And we've been talking about isolated or stranded assets with coal for a long time. But just this year is the first year that renewable energy sources from an energy generation standpoint exceeded coal. So think how long we've been talking about coal. It's a long process and it will take time. So I think a thoughtful, move towards renewables is what you should do. I don't think you want to move quickly. I don't think you want to move irrationally, But there is a transition going on. This is a major transition, and it needs to happen for a whole lot of reasons, right? It needs to happen for climate reasons. It needs to happen for energy independence. But the reality is oil's in everything, right? It's in every product around us, and it's not going away anytime soon. But we can help our climate by switching to alternative and renewable energy sources wherever we can. And I think that's what we would suggest is, depending upon what your individual objectives are as a board, that's going to inform kind of how quickly you move and where you move. There are a lot of energy companies that are saying they're doing the right thing, and they put a big green commercial on TV. Some are doing it, some are not doing it. So I think understanding which ones are really walking the walk and not just talking the talk is important. BP is a company that historically has not been on our investable universe. We have two screens. 50% of your revenue has to come from these carbon emitting technologies, or 50% of your CapEx needs to be going to it. BP is now investing more than 50% of CapEx in alternative energy sources. As a result, they now meet our screen. But most of the other ones, it's just a fraction of it's a single digit percent.
I don't even know if it's just for you, but I was thinking, so understanding, we've had folks say that they could use their financial muscle or with the company they're investing in to make change. But it seems like a lot of the ESG is getting pushed back politically. So I just wonder how, what does that lobbying effort look like? Because we know that it makes sense and for the future, but we have folks that are so focused on, capital gains or whatever. I'm just curious, like what are you guys thinking about in terms of just engaging the legislature to make sure that they're committed to getting these things done?
So we are not engaging legislature at this point. We're just a small boutique at this point. But and I think I kind of mentioned this earlier in that the policies and the politics, it's unfortunate for sure. And it is delaying the process in certain areas. And ironically, you look at certain states that are most susceptible to a rising tide, and those are some of the states that are fighting it the most. And it's unfortunate, and I don't really fully understand it. But where we're engaging is in areas where we think we can have an impact, specifically to ES, environmental, social, and governance issues at the company level. So with Paula Ingram as our head of impact, he's charged with that, and he's leading efforts. And again, as a small manager, we're trying to box above our weight, if you will, by engaging a lot of large pension plans to come with us. And so that's where we're trying to make an impact at the company level today. I think the reality is, and what we've seen in prior administrations being in office, it's a speed bump. This is a global initiative, and it's far above kind of one administration in office. Will it slow it? Yeah, but it's hopefully just a speed bump if it happens.
Mm-hmm. Any more questions from the floor? Seeing no more questions, we'd like to thank you, John Dewey.
Thank you so much.
I tell you, I had a hard time finding that book too, of his philosophy. But we appreciate you coming in.
No, thank you for the opportunity, and happy to be and available for any further questions.
Thank you. All right.
Hi, how's it going?
Okay, good afternoon and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, joining remotely, Trustee Rodriguez, Trustee Riley, and Trustee Woods. Our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Brianne Weymouth, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you so much. Thank you everyone for having me today. I recognize that I think I'm sitting between you and lunch, which is always a very coveted spot here. So I saw some sandwiches being rolled and I thought I was going to be the lunch entertainment, but instead I think I may be blocking you. So apologies up front for that. I'm Justin Heyman. I'm with the Rock Creek Group and here today to talk about our Smart Futures Fund, which is a growth equity focused private fund investing directly in companies that are enabling and benefiting from the energy transition. Listening a little bit from the hallway, it sounds like that's been the topic, at least of the last little while. So I think everyone, I'm sure, is aware of the tremendous opportunities, as well as some of the challenges and other unique aspects of the energy transition that's going on. So we at Rock Creek have been investing in the energy transition for 2 decades. We are a large global investment manager. We have been investing for the last 2 decades, primarily in funds historically. And this opportunity has brought us into the growth equity world to invest in companies operating in this space. And so really excited today to talk to you a bit more about it. On slide 2, just a quick introduction to me, Justin Heyman. I'm an investor. I've been investing in the climate and energy transition space for the last 15 years, largely along the lines of what we're doing in Smart Futures. So while it's a very popular topic today, it's not a space that's new to me or my colleagues. On slide 3, very high level, what we're doing, it's, as I mentioned, growth equity. We are focusing on companies that are creating innovative solutions that can create and capture value in the energy transition. So a couple of points there to just double click on. When we say growth equity, what we're talking about is expansion capital for companies that have proven technologies, proven businesses. They're seeing tremendous growth opportunities. These are companies growing 50%, 100%, 200% a year. They're private companies, and so they need capital to support that growth. So think about your solar developer, for example, who's seeing unprecedented demand for solutions. There's capital out there to finance the actual panels and the actual projects that they're building. But in many cases, let's say you have, a tool or a company that's really in that ecosystem, but not the actual asset itself. You need growth equity to support that, right? You need to hire people, you need to train crews, you need to build out your technology and expand like any other company. And so that's the type of capital that we provide. Also, we use the term energy transition today. The today part is a very important one as well. What we're talking about there is these are companies that are actually doing things and deploying solutions today. And our view there is that the energy transition opportunity is here now. We've all heard about the benefits of things like the Inflation Reduction Act at the federal level. States like Illinois have lots of incentives at the state level. There's a lot of demand from corporates and consumers for energy transition solutions that's there today. And the really good news is we have really great solutions that make good economic sense and good business sense to deploy today. And so that's why we're focused on this. We're not doing, venture capital focus on new technology that'll be really impactful in 2040 and 2050. That's great. We're so happy to see people focusing on those things. We're focusing on the things that we're invested in over the last several decades that are now ready at this place where they're ready to be deployed and ready to scale. On slide 4, one thing that's really important to us is that we're investing in things that are smart both from an energy transition perspective. So when we say smart transition, what we're talking about are things that are not only good for the environment, of course, that's fantastic, but more importantly, these are things that also make good business sense. So they have an ROI. There's a reason to do them beyond just the impact side of things. So if you think about things like energy efficiency or other type of resource efficiency, really good example, right? It's good for the bottom line, but it also enables the energy transition or reduces the reliance on resources. We're also looking for things that provide those results now, and we're looking for opportunities where they're well aligned to benefit from all of these tailwinds we see coming from the focus on this energy transition. Equally as important is, as investors, we do not forget that we also need to make smart investments. So we are very disciplined in how we look at these opportunities. We approach it just like any other top growth equity investor would. So we make sure that when we're investing in structures and valuations that make sense. When we're doing our diligence, we're doing the classic diligence that good disciplined investors do. So we look at things like customer concentration and supply chain issues. We do deep dives to make sure there's good alignment with the managers of these businesses. All of those types of things we think are really important. And the types of companies we're focusing on with our $20 to $50 million checks in each of these opportunities, these are companies that have proven unit economics. These are companies that are growing. They have revenue. In many cases, they have attractive EBITDA profiles, and there's compelling commercial traction. So we're not betting on some technology that it's going to work and take over the world. We're investing in places where we can actually go talk to their customers. In many cases, these are Fortune 500 companies, and we can say, are you buying this today? Are you happy with this? Are you going to buy more tomorrow? So there's a lot of certainty when we're investing that what we're investing in will ultimately achieve the growth targets that are being put out there. On slide 5, where do we find these opportunities? What sectors are interesting? So of course, energy and utilities is a big space. We also think there's lots of opportunities in things like the built environment and manufacturing and supply chain and transportation. So we look in those areas, but maybe what we find a little more interesting in how we think about this is these horizontals that are here. So what themes are we looking for? So the first one to point out, spending less to make more. This is sort of the classic efficiency or optimization type company. These are companies like renewables in places where renewables make economic sense. Those are lots of opportunities in that space where we can use things like even AI or other types of analytics where you're able to now figure out how do you more efficiently use resources. So those are the types of solutions that we see in these different industries. The second category there is supporting transition solutions. So the idea here is what sometimes people refer to as picks and shovels plays, but these can be service companies, these can be software companies, or other things of the like that are needed to support these high growth industries. So to give an example, there's a company we're looking at locally here, actually in the Chicago area, that is doing life cycle management for batteries. So these are batteries that are used in EVs. These are batteries that are used in power systems. These are new technologies that are being deployed really rapidly. The batteries themselves, there's a lot of question around what will that chemistry be, right? What will win in different applications? But to the customers that are deploying these batteries, they have to figure out, well, how do we maintain them, right? So if you're a fleet manager and you've been managing, combustion engine vehicles for the last 10, 20, 30, 40, 50 years, how are you maintaining a vehicle that now has, a very large and expensive and complex battery that's powering it instead of a traditional combustion engine? And so these companies need support, they need help. And if you're going to enable something like EVs or battery storage, you need a business like the one that we're looking at. The third one I would think that's really important to hit on is the concept of new market developments. So lots of times we have seen energy transition solutions that have been deployed in one place, but where those solutions have not yet been deployed ubiquitously. So let me give an example. Solar has been very well deployed in utility scale applications. Of course, there's still more opportunity there, but there's been a number of large utility scale projects that have taken place. If you go to a place like California and you go to the suburbs and you go to wealthy suburbs of big major cities in California, you see a lot of residential rooftop solar. Well, what about everyone else? The sun shines equally across the country, across latitudes, more or less. And so what about people that aren't in those markets? What about people that don't own a home? What about people that can't afford an upfront, call it $50,000 payment to put solar panels on the roof that will then provide them, you know, with essentially free energy, right? Makes a ton of sense if you can do it, but what if you can't afford that? And so there are lots of companies out there that we see that are now figuring out, well, how do you innovate the way that we sell solar so that we can bring that technology, which in lots of places can be a no-brainer, to other parts of people? So how do we get from the couple percentage points of penetration that solar has had in our overall energy mix to date? How do we get that higher so that it's everywhere where it makes sense and not just in these pockets? And so we see lots of companies that are doing that as well. As investors, we're very actively involved. As I mentioned, I've been doing this 15 years. I'm joined by, you know, as a team collectively, we have decades of experience investing in these companies. We know the space well. And we really see our differentiation providing the most value, and I'm on slide 6, in these steps here, right? So it's not just doing the transaction, it's figuring out, well, where are we gonna find these best opportunities? And then just as importantly, once we find them, how are we gonna help them be successful, right? We know in lots of cases, we know who their ideal customers are. We know we've seen companies that are growing rapidly like this before. We know how to help them figure out how do you actually do that. We know lots of executives, for example, that might be really helpful to some of these companies that have worked in adjacent businesses. And so we're able to really support our teams, and we're very actively involved. So we are not full-time operators. We don't become part of the management team, but also we wouldn't be doing our job if all we were doing is showing up at a quarterly board meeting and hearing the results. So we're getting involved. We're working in places that are opportunities for significant value. And a lot of times that also involves exits, right? So we know that ecosystem very well, and we help work with companies to strategically position themselves for an optimal exit. I did mention at the beginning that this Smart Future strategy that I've been talking about is part of the Rock Creek platform. That's really important, specifically in this energy transition space. I'm on slide 7 for 3 really key reasons. So first, energy transition is a space where policy is incredibly impactful, right? So as I mentioned, we're all aware of the Inflation Reduction Act. I'm sure that was done at the federal level, but what's really important is the specific definitions and what that Inflation Reduction Act will cover, right? And so we spend a lot of time with policymakers helping to understand where the policy is going, but also working to help inform in some cases where that can go. So we're actively involved in those dialogues. We help our companies connect into that world, and we use that to help shape where we're looking. Similarly, Rock Creek has lots of corporate partners and clients, and we work with them to spend a lot of time so that we're not sitting back and saying, hey, we think this is where the world is going. We're talking to the people that are actually shaping it, and we're saying, where do you think the world is going? So we spend a lot of time with corporate partners saying, where do you see the energy transition happening? Right? And oftentimes that can look quite differently than what you may see in a press release or a glossy brochure. And so we're able to have those conversations to say, hey, where are you spending money next year? Who are you partnering with that you like? Who's doing this the best? who are you going to spend more money with next year? Who are your competitors working with? And we use all of that to make sure that we're finding the best companies that are out there. And then we're circling back after we invest to say, look, how can we connect you with the companies we're investing in to form a commercial relationship? Additionally, really important, in the energy transition, growth equity is not the only type of capital that our companies need. It sounds like you guys have heard from people that are doing different types of investing. Lots of types of capital are needed in the energy transition. So for example, if we're investing in a company that's developing solar, they may also need infrastructure capital or project capital. They may need debt. At some point, they may need, be interested in going public. And so Rock Creek has relationships with funds across different asset classes that the firm has invested in. And so we're able to bring those relationships to our companies, which are really helpful. Also, Rock Creek has invested, I mentioned we don't do early stage venture capital type investing. Rock Creek is invested in lots of those funds as well, though. And so it gives us really great insights into where the next wave of companies are coming and who's doing really well. And so we get access to those companies and understand that ecosystem long before they'll be a fit for our strategy, so that when they do become a fit, we're well positioned to work with them. On slide 8, you can see the team that we have. So the Smart Futures team is across the top there. On the top right is Afsaneh Beshlas. She's the CEO and founder of Rock Creek. She's been involved in the energy space for the entirety of her career. So before forming Rock Creek, she was previously at the World Bank and JP Morgan working in energy and some of the early energy transition efforts. The rest of the team similarly has spent the entirety of our careers in this energy transition space. So I mentioned 15 years for me, Maria, for example, and Anahita, these are people that have been focused on these topics for over a decade at this point. We are supported by an institutional grade back office team at Rock Creek. And so you can see some of those functions and some of the leaders of those groups in the middle there. And then we also have a very valuable advisory board that helps advise the Smart Futures team on things like investing and policy and what's going on in the world. So I'll highlight, for example, Laura Tyson and Deanne Julius, who are advisors. They serve on many large corporate boards and have really strong connections to lots of leaders and important companies in the energy transition. These are companies like CBRE, Shell, British Airways, Morgan Stanley, JLL, Deloitte, these types of companies. They're involved at the leadership levels to help share perspectives there. Terry Dugan, very well connected in the policy world within energy transition. So she worked for Biden. She's an advisor to Energy Secretary Granholm and has lots of great connections and understanding of what's going on in that world, as well as connections into many companies that are on the forefront of what's going on in the energy transition. Petar Noor and Hossein Razavi, these are people who have spent their careers working on energy and the energy transition globally and help provide perspectives on what's going on, a more macro perspective. And Ray Rothrock as well, I should mention, has been an investor in the space for several decades. On slide 9, important to point out that we are not new to investing in the energy transition. This is a space that a lot of people have come into in the last couple of years. What you see here is a partial list of the logos of some of the companies in the space that we've worked with. I think important to point out, embedded within here are companies where we've done the Smart Futures strategy. We've done it successfully. So for example, Chainalytics and Comrent on the upper left, these are companies where we've invested along the parameters of what we'll do in this fund. You'll see that this is a target 3x and above MOIC fund with 20% or better IRRs. These are deals where we have achieved and exceeded actually significantly those return targets. Also, some of these other companies here, Raven, Series, Generate, Escalate, Gemini, these are companies where we have invested as a team at Rock Creek together, investing in the space. So we'll do about 8 or 9 deals just this year in the space with capital that we're investing today. And then across the bottom, you can of course see the other companies that our team has worked with in the past. On slide 10, I want to talk a little bit about some examples, maybe give an example or two of the types of companies that we're looking at. So I'll start all the way on the left. This is a company that is working in the CNI solar space. So what CNI is, we talked about utility scale, right? Those are really large projects. We talked about rooftop on homes. CNI is commercial and industrial. So what do you do if you're a grocery store or a big box store or a building like you might see out the window here? Developing solar on those types of locations has been a challenge historically. Rooftops of a home generally tend to look the same, right? They have maybe a chimney and an exhaust stack. There's pretty common elements you find. Rooftops of buildings like this, though, can be really, really challenging because there's all kinds of stuff up there. And that requires customization, which is expensive. Customization makes sense if you're doing some massive project, but if you're doing something that's kind of in that middle space, historically, that's been an overlooked space. And so this company is one that is investing in that space. It's growing very quickly. They need capital to scale. And again, we're looking at very attractive valuation there. In the middle, this is a business that is using imagery in order to map out farmland. And what they're doing is they're using those images to determine exactly how every plant on the farm is performing. So they can detect issues where there's overwatering or underwatering, over-fertilization or under-fertilization, where pesticides may need to be applied. And they can give that recommendation to a farmer in a very precise way so that they can use 10, 15, 20% less of the resources that are being used because they have this knowledge. So this type of stuff is really changing industries and how industries operate. And again, these are things that make a lot of sense for the end use, right? If you're the farmer, it makes a lot of sense to pay a bit for the service in order to save a lot on those resources. Also makes sense from an environmental standpoint. They're saving 10, 15, 20% of the water that's used in agriculture, as well as the associated energy, which can be really significant. On slide 11, I wanted to just talk a little bit more about Rock Creek generally. $15 billion global investment firm. On slide 12, I think what's really important to point out is that we don't talk about impact without doing it, right? We put our money where our mouth is, so to speak. So as a firm, I think we are the largest, or if not the largest, one of the largest diverse female owned and led investment management firms out there. Over 95% of our ownership is diverse. Over 75% of our management is diverse. Over 70% of our advisory board is diverse. And we like to show this last one, which is our internship class, because we like to show that this is something that goes from the very top of the organization all the way down to the most entry part of the organization. Additionally, on the left there, you can see some figures about the different capital that we've put to work in the way that we're investing as well. So over $11 billion that's been invested in sustainability investments over time, as well as in diverse managers, diverse companies, and other diverse opportunities. On slide 13, the fund itself, what we're talking about is a $300 million fund. As I mentioned, we're looking to make $20 to $50 million investments in companies. We think that's a really interesting space. We don't see competition in that space from other funds that have expertise in this area. That roughly pencils out to about 10 to 12 investments in the fund in total. We look at both minority control and majority control opportunities. And maybe most important of everything on this slide, we think that the energy transition is an enabler of fantastic returns and top performing returns. We do not see this as a concessionary strategy in any way. Given the type of investing we're doing, we see energy transition as a tailwind for our companies. This is not something where we're, needing to take performance haircuts because of the focus on the space. I will leave it there for an overview, but would be thrilled to answer any questions that any of you may have, or if it's helpful, I can dig in on any other areas as well. But thank you so much.
Are there any questions from staff? Yes. Okay, hold on. Okay, go ahead.
So I think your company is doing something a little different than some of the other companies we listen to. You made me think about how different investment groups like ourselves there's probably a need for various groups to invest, to look at and have different partners, have different strategies to achieve the goal. I don't know if you have, if you can elaborate that. I don't know how much of the, how the divisions are going. Is it just happening? Can you explain that, please?
Yeah, sure. So the way we think about it is that the energy transition opportunity is a economy-wide shift. When we say energy transition, it's a shift from the traditional economy to this new economy that is likely decades away. And because of that, what we see is that there is opportunity and need for capital across all types of asset classes. In Rock Creek has been investing across all of those asset classes for years, for decades. And specifically why I joined the team and why they were interested in me joining the team and why this is the area where they're saying we need to get into the direct investing business is because the landscape out there, what you have is you have 200 some odd venture funds that are now focused on the space, investing in new technologies and startups. And that's great, but that's a lot, and that's a lot of capital, and there's a lot of focus there. You have some very, very large private funds that are now also focused on the space, right? So $15 billion funds and $8 billion funds. And they're focused on investing in companies that need a couple $100 million to call it $1 billion. And that's great. There's not a lot of companies, by the way, that have made it to that space in this market. This is a newer market, but there's a lot of capital there, and there's a lot of big name investment firms that we all would know that are focused there. What Rock Creek saw, though, was that there's a lot of space that's in between, right? There's a lot of companies out there that are 25, 50, 75, $100 million type businesses that are smart. They're making lots of profit. They're seeing huge growth, but there's not much capital focused on that. What do you do if you need $30 million? Who do you go to, right? And some of the examples I gave are great examples of that, right? Where it's like, I've got a pipeline of $500 million, but I have no way to service it. So why am I willing to bring on an investment partner when I haven't at all for the last 2 decades? It's because I'm leaving a lot of money on the table and I'm not really satisfying my customer. And so I recognize by partnering with someone that can provide that capital and also, by the way, help me figure out how do I grow from 50 people to 200 people, and how do I find a new CFO or a new head of sales that can manage that, or I don't know anyone at XYZ company, Fortune 500 company, but they would be a great customer. So that's where someone like us comes in. And in other areas, right? In software, that's a very well-defined category. There's lots of funds that have done that for years. In healthcare, you've got lots of people in pretty much every other area. That middle is where people have done and do very well as an investment firm. So what we're really focused on is that space. We see that as that's where there's actually the most opportunity, and that's where there's the fewest dollars. And so that's kind of how we look at the world. I think from what I've seen, you know, the focus on public companies, that's great. Like, again, it's sort of this barbell where there's like a focus on the two ends, but where there's the real opportunity that we see is right there in that middle space. And it's helping kind of these, you know, small, medium sized businesses grow.
Thank you.
Yeah, sure. Thanks.
Yes. Yes, Vincent, please.
I was just wondering, have you seen any viability in direct carbon capture in terms of, you know, making a direct impact? A lot of these are kind of, you know, indirect, but talk to us a little bit about that.
Yes. So the way we think about technologies like carbon capture, so what one of the parameters we have for this fund is that the companies we're investing in are companies that need to be profitable, and it needs to be profitable and make sense and offer attractive ROI without subsidy or without long-term subsidy. So we don't make bets that that these, you know, subsidies, we think they're great, and we of course try to find opportunities where they are. So solar is a great example of that. But we also need these businesses to have solutions that are smart and make sense, even if you remove all subsidy and all incentive. So solar, again, a great example, right? It makes a ton of sense in a lot of parts of the country. Of course, if you start giving, you know, with the Inflation Reduction Act, $7,500 to people that are going to put panels on their roof, you sell more. So it may get us to a more of an upside scenario. But if you remove it, solar still makes a lot of sense in a lot of parts of the country. We haven't seen carbon capture quite get to that point yet. And so it's not something that we're, if you looked at our near-term pipeline, there aren't opportunities like that yet. Over the course of this fund, you know, this is a 5-year vehicle, maybe that will change. We do pay a lot of attention to it, but not yet in terms of what we're looking at. We'd view a lot of, I mean, at least the companies we've seen, we would put more in that venture category for them.
Okay, we're almost at time. I don't see any more questions. Anybody? If you want to give a closing statement.
No, I just would say thank you so much. I think there's great alignment here, given, you know, the types of businesses that we're investing in, and from what I understand, you know, the goals and you know, missions that your group has, right? And so I think, you know, from a return standpoint, something that makes a lot of sense. But I also think from in terms of trying to have something that we can, you know, show results now. The types of companies we're investing in, they're the ones who are deploying these solutions now. We can track, and we do track what that impact is. And so very disproportionate impact as well. So hopefully of interest, and would love to talk further.
All right. Thank you so much.
Appreciate it. Thank you.
All right. Okay, why don't we take a short biological break, and then I would like to come back and get reactions. Okay? All right. Thank you. Okay, we're going to get started with reactions from our Chief Investment Officer and our consultant, Callan. Callan, you would like to, Leanne, would you like to go first?
Oh, sure. Okay.
Hold on. Oh, okay. You know Lois is leaving. She left. Okay. All right.
Okay, great. So good afternoon, everyone. I thought today was a good meeting. We got to hear from 4 somewhat different service providers. So we've met with all of these providers at this point. Legal in General kind of started out with this very customized approach. They can provide a lot of different services. So they can provide the list. That was something that we didn't want to divest, but we wanted to do something. And so they can provide you a list. They can work with all of your managers in implementing that list. So that's, one way, one direction that we can go with them. What I liked about both Legal in General and Neuberger was their focus on minimizing the impact of this on the overall portfolio. So you don't have to take a stand and have your returns significantly impacted or the positioning of the portfolio impacted, but you can still take some action. So that's what I liked about both of those managers. Legal in General also can do some passive implementation. And the fact that they're a UK company, have been working with European investors for since the inception of ESG over there, they have a lot of experience, a very built out team. So I think that they would be a great partner in some way, however we decide, would be a good way to work with them. And then moving on to Neuberger, this strategy, actually one more thing on Legal in General, they also have a new strategy that was just funded like last month for a client in the climate area. So we won't have any performance on that, but they actually do have some money working towards an active strategy in the space that we can always take a look at as if we get more performance from them. The Neuberger portfolio is one where you would implement like an S&P 500 passive strategy, and then they would do this energy transition just within the energy portion of that. So again, a strategy that's one where you would have kind of a full S&P allocation. You wouldn't have to carve out a separate energy transition portfolio. So it's also a full solution. And then just a little bit different in the way they implement it. And it would just be implemented within really the S&P 500 index. It wouldn't be something that would work with all of your managers. And so that's, I met with them, as I mentioned, about a year ago. So they've been working on this for a while, still working on getting assets and that type of thing. But it's something that's been in the works for quite a while. Then Viridian. Oh. Mm-hmm.
So with those asset classes, then essentially they would be taking funds that we currently have in fossil fuels or what have you, and transitioning them to other funds that may or may not still be in fossil fuels, but they're in something that is, or companies that are engaging or transitioning from fossil to other climate-friendly ventures.
Right.
Okay.
Yeah, and one of the things, and I know you all talked about this when you put the resolution in place, is the risk, the financial risk of owning coal companies. And both of the Legal in General and Neuberger strategies focus on minimizing financial risk if you stay in companies that aren't changing. So yeah, that would be what, and they would do that in an S&P 500 context.
That's what they meant by
Mm-hmm.
I like the strategy that they did talk about
Yes.
I think that we just pull out what we were saying, and talking about in New York this past week is, exactly what was shared here.
Mm-hmm.
They pulled out, they lost. They could afford, not that anybody could afford to lose a lot of money, but they did. And then started looking for other investments. So, that was a great design.
Jackie, your mic's not on.
I'm sorry, you didn't hear me? Did you hear what I said?
It was very
Yeah, now I can hear
difficult. Yeah, it was very difficult. You sounded muffled and we can't see your face.
Okay, well, I can't help you with that one.
Well, because the camera, you're the well, because
I am in person, so they have the camera on that side of the room.
I know. That's what I say
Yeah,
you're the
so-
chairperson. We should be looking at you. Thank you.
All right. That was a comment, not for me.
I
Okay.
hear somebody
so-
whispering. We can hear
No,
you.
that's me. I said that's an accurate comment. So listen, what I was saying is that I work with AFT a lot and we are gleaning a lot of information from them. They did actually divest, and that was billion dollars. They have a very big fund, and that was just money that wasn't making money. That's what I was saying. And now they're stuck is what I was saying we were hearing from these presenters. So they're looking for better investments, but they could have actually engaged these people. When you're moving that kind of money, you could have engaged some of these companies rather than, making a headline, statement and then just pulling $5 billion out, even though they had a lot in there. But that's what I was saying, Maria. Okay.
Yeah, so the first two providers can help you with that. So Veridian's an active manager. This is, we would be moving into hiring an active manager to manage assets that are in alignment with sustainable climate investing. They are a new firm. They are very small, less than $1 million. So, typically we haven't invested in firms that small. I know they do, they are positioned to become an institutional investor, but they are just getting started.
Right, okay.
And it's a global portfolio, so combination of US and international companies, and it is focused in certain sectors. So this would have a higher tracking error. And he showed you that information when he showed you that the returns are high, but it also has a lot of volatility. So this would have an impact, potentially on returns because you are being active and very different than the benchmark. But they have shown to be successful at adding value. So that's another strategy that, we can consider active managers like that, but at this point, they're small. They're not really able to do the same engagement that you get from these bigger players that have all those assets behind them.
Okay.
Did I hear you right, that they would become involved in the more renewable or environmentally friendly assets? Did I hear you right? I wasn't sure if I heard that right.
Well, their strategy is sustainable climate investing. So they're only investing in companies that support that, but that means that they're going to look very different than an index. Yeah, so if you look in the presentation, they have their sector allocations. He said they added a lot of value just by security selection, but they're not holding like certain consumer companies at all, certain, industries they're just completely not in. Okay. So you'd be taking more risk.
Yeah.
And, they are small, but they're not the only manager doing something like that. So I think we'd have to make a decision. Are you interested in doing something that would be very active and move away from benchmark, add volatility, or more interested in the first two, the strategy that's minimizing the potential tracking error and difference from the benchmark, but still supplying more of that engagement. So those were just two different approaches to this. And then the fourth manager, Rock Creek, is one that we know well. However, this is a new strategy, and this is a direct private equity investment. So this would be part of a pacing study. You would invest in the fund, and then you'd be in the fund until they completed, 10 to 15 years.
Yeah, a long time, long time. And I was just wondering, we have heard all kind of horror stories about companies that have started out being profitable, but when you acquire all this debt and then you transfer it over to the companies, they typically fail, or they struggle. They get to a place where they're struggling. And I'm concerned because we just raised our private equity allocation to 8%. But we're already at 9.1%. So the 8% allocation was just bringing us closer to being over allocated, or the reduction of the allocation. So and then I'm concerned about the lack of transparency with private equity and the ethics of, what's happening with these employees at the companies. We are teachers. We are, we belong to labor union. So, but we always have to be humane. We have to think about the people in these companies that are working. So that's my concern with that one. Just me. I'm just saying me, because we did a lot of case studies on companies that thought they were going to be doing great. They were doing good, and then thought they were going to be doing great, and then they ended up buried under debt because the money has been borrowed. You transfer the debt, and you walk away with the cash. So, just my interpretation. Okay.
Jackie?
Oh, I'm sorry. Yes, Mary Sharon, please.
Yeah, this is a female-owned firm out of DC. I don't know historically how their performance has been in other areas. I think that would be something we'd have to look at.
Right.
At one time, Kathleen Kennedy Townsend was with them, and I met her years ago.
Yeah.
But as they say, it is a woman-owned firm.
Yes, I did hear them say that, and actually I wrote that down, that they were a female-owned firm. And that's why they're listed as the MWDBE. So that, I'm talking about private equity, period.
Right. Oh,
whether
absolutely.
It's minority, majority, whatever,
Yeah, and I think that's Brianne would have, or Callan would have to look further into it.
No, that's what I'm saying. So that's why I'm expressing my thoughts right now. So, and I know due diligence has to be done, and we have to find out if this is going to fit into our portfolio, if it will fit into what we have agreed to do by 2027. And I even think that needs to be fleshed out a little bit more. Okay.
Who, did you hear your hand?
Quentin?
Hey, guys, put your mics on.
I will, Mary. So I sort of agree with Jackie in the sense that, there's a little bit of lack of transparency in private equity. There's a big risk for us. They're still at 2 for 20, right? It's not doing well. They're still getting their 2%, right? Still taking 20% of our profit. I wish they are a small boutique, like he says, boutique company. And it doesn't seem as if they're like the first two companies, right? There's no direct impact to environmental issues overall, where the first two companies sort of indicated that they are working with larger S&P companies to try to move them to, be better global citizens, right? And so, it's just a little worry for me, that's all.
Yeah, and one thing with a private equity, you'd be putting like $10 million towards it.
Right.
So it's not going to make a big dent in your overall portfolio. And it's the first fund that they've ever done like this. So it's really hard to diligence because we don't really have a track record.
Mhm.
Yeah.
Which one are you talking about, Brianne?
Rock Creek.
Oh,
Yeah, this is just a new fund series for them. I mean, what Rock Creek is kind of known for is more of the fund of funds and investing in emerging funds. So emerging minority women-owned funds. So that's really where we know them. This is a direct investment. It's 10 to 12 companies. They would be working closely with them, and a small fund at 300 million. So you would be like 10, something
10,
like that.
15.
So as far as the overall CTPF portfolio, you're going to get a lot more bang for your buck in the public space.
Exactly.
So yeah, I like the whole boutique thing to a certain extent. And then the other thing about the private equity in general is the fee structure. But in my opinion, the more I've thought about it, it is also too about what we agree to. Because just because they say that's their fee structure don't mean we have to pay it. I think that should be negotiated if they want our funds, period. Regardless of what the standard, whatever, that may be a bit, what's the word I'm looking for? Audacious, for lack of a better word. But I mean, so, and the other thing though for me is I think in this moment while we're talking about trying to divest and engage, I do like the idea of looking at someone who is going to actively do both. Like, because I do think there is something to, if we're already in certain companies that could potentially be transitioning, why sell our interest in that company and then turn around a few years later and try to buy it back at a higher cost when we were already there and could have benefited from the transition. That seems illogical. But then the flip side is there are some of these companies that's going to never do the right thing and transition. So we do have to be thoughtful of that as well. So that's one of the things that made the first company appealing their strategy, because you got somebody that's going to kind of walk us and guide us through what we really need to inform us with the information that we need to be able to make really good decisions, strategic moves, so that we could be the most efficient with the way that we either divest or engage or both. And so I'm hopeful that personally, I think that's the direction that we need to be headed in, period. I think just any type of, as far as that type of a structure, I'm not saying specifically that company, but that type of a structure that's giving us the space to really be able to have somebody that's going to know how to actively engage with these people and have the leverage of their name, their know-how, or whatever, to really be able to do that. Because I think that is the spirit of what our commitment to disinvestment was about. It was about being impactful with our climate investments and how what we're doing impacts, not just the environment, but we also have to think about ethically like workers and things like that. We are members of a labor union, as Trustee Price Ward just said. And even in private equity or any company for that matter, it is important to me and increasingly important that we are watchful and mindful of how these companies that are doing these buyouts and stuff or whatever, how they're going in and impacting the way the workers that are there. Because I would hate for our name to be associated with some nonsense because somebody went in and used our dollars to basically disassemble a company, and now you have thousands of workers that have lost their jobs. Or we have a company that has decided to be anti-union and are creating grief for their staff that maybe want to organize. Those types of things are extremely important to me because I think that they our support by giving them resources, we're essentially endorsing company behaviors. And so I want us as a fund to be very intentional about where our monies are going, really knowing these people's track records and how they do their business, where they've done their business in other places, because I think that is very reflective of us as an overall pension fund, as a trustee board. And I don't like my name attached to nothing that's chaotic and confusion. You know, my grandmother used to say that your good name is worth more than your weight in gold. And I think that CTPF has traditionally had a reputation for being the standard setter. And we're not nearly the biggest fund in this country, but people respect the way that we do things. And so in that spirit, I think it's important that as we're transitioning out of this, I think it's important that we show others how it should be done in the most appropriate way, so that maybe everybody else will take a page out of our book, and that's how bigger impact happens.
Trustee Vincent?
And I guess to that point, I'm wondering what is the most appropriate way? Because you think with active investment, that you're like working with like emerging markets or whatever, and you're actually funding them and hoping for, you know, future gains. But there's also a benefit, I guess, in, you know, trying to make change from within, like established ones that you're setting policy, and hopefully not only company-wide policies, excuse me, but national or global policies to help get us, you know, closer to a climate change agenda. So that's my thought. Would we have to, can we could just split it, I guess, basically. So if we're working with the group that may have, you know, the active group, I think that was at Rock Creek, that said they were more actively involved. And then looking at well, actually, I also like that about Rock Creek at all. Also, they have a political agenda. They're saying they're going out and trying to impact policy. But the thought would we be tied to only one method? How could we make sure that we're diversifying and getting, you know, more bang for our buck?
Right. Yeah, I mean, Legal in General said it, there's no one solution.
No, it's not.
And you know, I think that we need to talk to a few more firms. And I think that there is the possibility to use more than one provider. You know, and see how they each do. Because there are some different, you know, approaches here. And you know, the thing with the public companies and like Legal in General and Newberg are big companies, so they have that interaction. On the flip side, Rock Creek's making, you know, they said 10 to 12 investments, so 10 to 12 companies. However, they're going to be very involved with the management of that company. So they're going to be able to impact how it's managed. You know, and half the companies, they said they would have a majority, they'd be a majority owner. So they would have a lot of influence. But, you know, you're only reaching 10 to 12 companies, whereas the other couple are much more broad.
And the 10 or 12, but they're still like basically new, so you have we can't extrapolate what they're gonna do or can't.
Yeah, I mean, they would go in and do what they see fit.
Yeah.
Yeah.
Or what they say they're going to do.
Yeah.
See, that's a concern. Okay. All right. No, he's not feeling well. He got sick. Oh, I'm sorry. I see Trustee, I don't see Rodriguez. I see Riley.
She has her hand up, it looks like.
Yeah, I do.
Okay, I'm sorry. Trustee Rodriguez, go ahead, because you haven't spoken. Is she here? Okay.
I'm sorry. Yeah, no, I'm sorry. Do I have my hand up on here? I apologize.
No, you don't.
No.
Okay, you were just asking. Thank you, Jackie. No, I'm just listening to the dialogue.
Okay.
Thank you.
All right. Trustee Riley?
Yeah, I was looking at Legal in General. For one thing, how old they are. And yet they've only been in this country since 2006. They've been around since the 1800s. And they decided to come to the US. And they're huge. I mean, I don't know whether they're effective, but they certainly are big. And I think they're interesting to look at. Not ready to jump in yet. Thanks.
So
Yeah,
yes.
they have
All
a
right.
history of managing pensions in the UK, which are different, the way that they're managed versus here. So that's their fixed income capabilities that they reference, their custom capabilities. That's really how they got their start.
Okay.
I mean, they have
Trustee Ochoa?
$1.4 trillion.
Yeah.
Yeah. Okay, trustee Ochoa?
Yeah, I think, well, this presentation from all these groups was very informative. I think I was taken by the different approaches. So if not Rock Creek, people that are in that area, they just they're helping sort of build the bridges to, for the economy to move over to something else. And that's an important piece. That's a very dangerous game to play though, for us to be part of it.
Glad you said that.
But so you have to watch your risks there, but yeah, that's huge though, that there's companies that make it that are going to be able to take advantage of solar or other things or whatever it is. But the presentations by mostly I think LGIM and Newberger, I think they talked about the work that has to be done behind the scenes. I do like that. I think I might be confusing that. I think Veridian said they had connections with legislators, policymakers, so that would just seem like it'd be an obvious thing to have in place. And so for some to say they don't have that piece, I was just wondering, because you want to have somebody to tilt things a little bit if they can. You can't, just because policymakers doesn't, or you have connections doesn't mean that you're going to make it go through. But the more people you have in there that have a voice, it's going to help. That was my 2 cents.
Trustee Ochoa, I heard John Dewey with Veridian said that they were not at that level to be in politics.
Yeah.
So it's the other one. I just wanted to make sure that you knew that.
Yeah.
He said they're not at that level. They're small.
Yeah. Yeah, trustee Ochoa, it was Rock Creek.
If there are no more questions, we have any more questions? Or now we can go to our Chief Investment Officer.
Yeah, just to, I guess, to wrap up, again, as I mentioned at the beginning, our focus will be in 2024, fleshing this out, because a lot of these things we were able to bring today because of the conversations we've had over the whole year. Actually, I started talking legal in general beginning of earlier this year. So, and mind you, by the way, a lot of these strategies weren't around 3 to 5 years ago. So who knows what's to come. And so to your point, Trustee Price-Ward, about like, let's talk about what we really want. So then we can, when we do go out there in the market, eventually we have a more definitive sense of, what we're looking for. We hear you. And I think having optionality and flexibility in the partner won't pigeonhole us in one solution that we'll regret later on, I think. So finding a partner who has resources and tools and that will allow us that optionality and flexibility, I think is going to be important. But again, this was just to give you a feel and a taste of what's out there. And there's a plethora and there's a lot more. I'm sure that wasn't even really scratching the tip of the iceberg. So this was just, 4 firms who, and I know your database, Callan's database, they flagged a couple hundred maybe firms maybe in that database that
I don't have
solutions. So, who knows? But this will be a focus for 2024, definitely.
Thank you so much for doing this and bringing this to us. It was at the perfect time.
Yes.
Because I mean the absolute perfect time, because we have fresh knowledge and we have seen a lot of different perspectives just this past week. And we have seen what has happened from jumping in early and just say, hey, forget it, divest, which was a very significant impact on even small campaigns. And, but you can't, and then when you have these people with this, just get out, just get rid of it, just this, that, it's not that easy.
No.
And they are not concerned about the impact. So I was very happy to hear about the balancing, the divestment with the impact and looking at other solutions going in. But thank you, appreciate this.
My pleasure.
If there are no other questions, we can adjourn. That's all, we need a motion, we don't do the roll call, right?
Second,
Okay,
second.
all right, so all in favor?
Aye.
No, well, this time, because, nobody's online. Okay.
I'm still here.
I'm sorry, except for, well, he said since we don't have a quorum in person, so we could just do it this way.
No, that requirement for all votes to be done by a roll call vote was part of the requirement when you were doing remote meetings under the disaster declaration. This is actually an in-person meeting. Typically with all of my districts or clients' funds, that when we have a adjournment, it's just a voice vote. You don't need a roll call vote. Quite honestly, if everyone left, the meeting would end anyway. So.
Yeah, you absolutely. Thank you for that clarity. Okay.